Hi, good afternoon, everyone. Welcome to the virtual Stocks on the Rocks, our second edition. I'm just waiting 2 minutes for more people to come online, and then I'll have the moderator do the introductions. Hey, Fiona, good vibes. Artista, what's up? Greetings, greetings. I hope everybody is staying safe and staying inside. Hey, Milsey. Check. Just checking if YouTube is hearing me clearly. Just raise a hand or say good if YouTube is hearing me clearly. Hey, Soti. Is Twitter hearing me clearly? Excellent. Excellent. Welcome, guys. You know, me always have problem with flow, and today is a problem day as well. All right, so it's 5:02. We waited the 2 minutes. Let's get started. So I'll pass over to the moderator.
Thank you so much, Simon, and hello, everyone. Thank you for joining us for Stocks on the Rocks, SOTR webinar financial statements edition. So this afternoon, we'll be touching on four primary areas. The first being an intro to financial statements. I mean, what are they? Why are they important? And what exactly do I need to look out for? Then we'll be taking a closer look at financial statements for manufacturing companies, financial companies, and real estate companies. We'll also be looking at PE values. So let's get this rolling, starting off with Simon Johnson. He needs no introduction, but he is the founder of Stocks on the Rocks. He's a senior capital markets analyst, adjunct lecturer, and development enthusiast. Simon, take it away.
Thanks for that very enthusiastic and vibrant introduction, Shanti. All right, she lively, yes. All right, so guys, welcome to this edition. Let me just give my short introduction as well. So one of the one of my major goals is to improve financial literacy levels locally. And if we have to do that one person at a time, it's going to be one person at a time. So over going forward, and we've been doing this since mid last year, we expect to do more sessions like this where we touch on topical issues, and I try to have the professionals come and explain some of the things that confuse us as it pertains to finance and investments. So today we'll be doing a beginner's guide to reading financial statements. So we're looking very basic, but I believe that there is something for everybody within this presentation. So let's go. So just an outline. So I'll be starting with an introduction to reading financial statements. Um, I am going to talk about some of the basics, some of the first things um, that you should be looking at when you're looking through financial statements, where you find them, etc. And then the presenters will go into different types of financial statements. So, for example, we have the first presenter who will be going through manufacturing and distribution statements. The second presenter, financial company statements, and the fourth presenter through real estate and private equity statements. I know everybody is very interested about private equity now, so just stay tuned for that. So let's go through some of the basics. And guys, I'm gonna have a question and answer session, a small session after each segment. Okay, so just save all questions until then. So the three main financial statements that we're going to be looking at today are the income statement, the balance sheet, and sometimes we call the income statement the profit and loss statement, the balance sheet, and the cash flow statement. Now, the income statement shows you money coming in the door and money going out and what's left over after. So I wanted to find some bag juice images to put on this, but time ran out. So if you think about a bag juice business, if you make one single bag juice and you want to sell that, how much are a bag juice now? A bag juice is around $20, right? So if you make that one bag juice, right? And you sell that bag juice to, let's say I sell that bag juice to Shanti for $20. The total sales of my company is going to be $20. So the income statement shows the money that's coming in and what's going out and what's left over after. It shows the total income, revenues, or slash sales of the company, and it shows the total expenses of the company. And as I said, the presenters will be going in detail because depending on the type of financial statement, the financial statements will look a bit different. Even though they're really saying the same thing, this is the amount of money that the company made, this is the amount of money that they spent, and this is the amount of money that's left over. The balance sheet gives a summary of all the assets that a company owns. So when you look at any balance sheet, you're going to see a large asset section. This is everything that we own, right? And then it shows you what the business owes. So I like to say it shows you who those assets were purchased or what we call financed. So for that bag juice business, for example, when you have one unit of a bag juice in inventory, let's say you have one bag juice in your fridge, that's basically what's going to come up on your asset side, right? And it shows the total, what we call liabilities of the company or what you owe. So assets can either be purchased, financed through cash that is yours, or from cash that you borrow. And the balance sheet breaks that down. And the presenters today are going to go through some of the details of that. Now, the cash flow statement is a bit different from the income statement. You see, the thing is that the income statement doesn't show all the cash that's coming in and the cash that's going out. So, for example, the income statement has expense entries on it that you didn't actually pay out cash for. It sounds weird, right? So, for example, something like depreciation, which we may be familiar with, is an expense item, but it's not a cash item. What the cash flow statement tries to do is it tries to correct the income statement such that it reflects just all the cash that's coming into the business and the cash that's going out of the business, right? So you can say if the business was like a tree, the income statement would be like the fruit on the tree. So what you pick and you get what you reap. The balance sheet would be like the trunk and the roots of the tree, while would be like the balance sheet of the business. But the water that you use and water the tree would be more like your cash flows that supplement your business. Now, all listed companies must provide the JC with what we call annual statements, quarterly statements, and an annual report. So let me give you some backdrop. So we're talking about the three main financial statements, right? Anybody remember? You have your income statement, your balance sheet, and your cash flow statement. Now, these statements, once a company goes to the stock exchange and says, hey, I want to list on the stock exchange, the stock exchange is going to say, okay, fine. However, you have to get through these things, or you have to provide these things, or these are the requirements for you to come on my stock exchange. One of those requirements is you're not a private business anymore. You have to tell your investors what's up with the business. How much money do you make? How much money did you borrow? Where is the money going to in terms of the expenses? So every 3 months, or what we call quarterly, every quarter, every 3 months, companies have to provide their quarterly financial statements to the stock through the stock exchange to investors. So you will see those statements come out on the Jamaica Stock Exchange website in the news section, or there are companies that have those statements on their own individual website. Now, at the end of a financial year, though a company has provided their financials, say from January to March, for the next 3 months and for the next 3 months, sometimes investors also want to say, look, I wonder how this company looks for the full year, for the full 12 months. Now, that statement is called an annual financial statement. So we have an annual financial statement and we have quarterly financial statements. Now, the requirement, I believe, is that quarterly financial statements must be provided up to 45 days after the quarter has ended. So let's say that the quarter for a financial for a company ended on December the 31st, 2019. But the company must provide to the stock exchange a quarterly statement for that quarter, um, up to 45 days after that period. The annual statement, a company must provide their annual statement to the stock exchange up to 60 days after the period. Right? I hope everybody following me. Now, the annual report. Well, we're going to look at the annual report a bit more, but the annual report is not just financial statements. But we're going to go to that in the next slide. So the annual and quarterly statement show details relating to the financials of the company, but the annual report gives a full review of the company, what it has done in the last year and what it hopes to do going forward. So this slide gives you an example of that. So an annual report, remember we're saying that the financial statements, the quarterly statements, the annual statements include are really your financial statements, right? Now, the annual report includes the financial statements, but it also gives other information about the company. The annual report is usually a big, fancy, very colorful document. This is the company beating its chest and saying, look, this is what I did for my investors for this year, and this is what I want to do for my investors for next year. So for this year, they will say, okay, this is what the company does. These are our brands. This is what we sell. The chairman may give a statement and say, oh, I'm the chairman of the most wonderful company in Jamaica. The CEO of the company or the managing director will also give a statement saying, look, this is what we've done over the period. I made this amount of money and I made this amount of money more than I made last year, right? That's called a management discussion and analysis. You will hear the guys refer to it as an MD&A. It also gives things about the what the company does in the community and a lot of other information as well. So if you realize, I alluded to on 2 slides ago about audited and unaudited statements, right? But there is a big difference between the two. So audited statements are those that have been reviewed by an outside accountant. So let's say you work at a company, you work at company XYZ. The CEO, you're an accountant there. The CEO says, okay, here what? Do up the financials for January to March. and you do up your financials and you give him the financial statements. If he goes to the bank or goes outside of the business with those financial statements, people are going to say, look, these are what we call management statements or unaudited, or this is an unaudited report. An audited report is when an outside party takes a look at the financials. So if he had prepared those statements and gone to PwC or KPMG and said, hey, these are our financials for the 3 months or for the 12 months. The guy at KPMG would say, okay, let me take a look at that right now. Sorry, that's my PwC voice. Let me take a look at that right now. Okay. So the auditors at PwC would go through the financial statements in detail. They would require all the invoices. They will go to the company and sit with everybody and annoy them. Sorry, I said that, yes. And go through all of the details. And then they will sign a letter saying, hey, we took a look at this company, and this company seems to be doing all that it's supposed to be doing as it pertains to accounting standards. So the auditors work basically in a way, they work for us in ensuring that the financial statements are sound. So let me just to recap, an unaudited statement is the one that's done internally that has gone through no full external scrutiny from an auditor. And the audited statement is one that's usually signed and prepared by an external auditor. So if you look at the screen now, I just took two snippets, and the source of this is the audited 2019 report for Panjam Investments. So it's actually much longer than this. It's a few pages. So, and this is very important, guys. This is basically the auditor giving you what they call their opinion on the strength of the company following the accounting standards, right? So they will say, okay, if you realize over the left-hand section, it says our opinion, in our opinion, XYZ. If you realize in bold, it says what we have audited. So they go through all the financials that they've audited for this. And they tell you exactly, this is what we've looked at. And it looks fine to us. So in the last part of the audit report, it will say, okay, in our opinion, proper accounting records have been kept, etc., etc., etc. This is actually a very important statement to read, because there are some companies who have gone through problems with their auditors. And if if an auditor can look at a company's financials and say, hey, we see the financials, but personally, we not trust it, then investors should also take heed. Hold on a sec. They said they're not hearing. They're not getting any sound. One sec, guys. Oh, cause I hear. Okay, okay. So some guys, check your audio, please. Some people are saying they're not hearing. Some are hearing. Okay, good, good. So this statement is very important. A lot of the times when we get the financials, we are so excited to see that our company has made more money, and the stock price is likely to go more. I will kind of skip through all the what the auditors report say and say, blah 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 blah. Oh, they made more money. Good. No, the auditor's report is also important. So let's talk about financial notes. So financial statements are accompanied by notes. These notes give users of the financial statements more details. I usually tell my students that if you think about it, the financial, think about a company. So this is Panjam Investments. Panjam is a huge company. You know what? Let's go to a company that more people are familiar with. Let's say NCB Financial Group. NCB is a huge financial conglomerate across Jamaica and the Caribbean, right? Now, the auditors and the accountants have all put all of NCB's operations in just a couple pages. They have summarized their operations. You may look at a number in the financial statements, and because you are so acutely aware of these things, you might say, wait, so how them sales move from $5 to $95 in 1 year? No man, we want to see why or what happened. What the notes does, and the note, if you see that red arrow, guys, the red arrow that's pointing on this green long egg looking shape. So those numbers are what we call notes, right? So let's say you looked at Panjam Investments and you saw that their investment income moved from 1.06 billion in 2018 to 2.25 billion in 2019. This is your company. You really like this company, but you're saying, no man, I need to know more. I mean, this is the point of this session. This is the point of detailed financial statements. I need to know more. Why did this number more than double over that period? So what you will do is move across to the left, and you see where that number is that says 5. There is a whole long list. So just to step back a bit. A financial statement, the financial statements alone are usually about, boy, depending on the size of the company, from 4 to about 7, 8 pages, right? However, the full financial statement can go up to like 60 pages. So that means that 50 odd pages out of this report is not the statements itself, but a majority of it is just the notes explaining what the statements are saying. So, for example, a lot of people don't know that you can look in the statements and you can see which banks some of these companies borrow their loans from. And sometimes you can see at what percentage. You can look at certain companies in Jamaica and see how much their top CEOs get paid just from the notes. You can look in the notes and actually see how much money the company manages outside of what is on its balance sheet. So there's so much information that is not here, right? But I mean, the presenters will go more in depth in this. I don't want to take up their time. So financial ratios. So I won't be going through in detail the financial ratios, but let me just give a snippet of what that is first. Financial ratios help us to look beyond the numbers on the income statement and balance sheet. Financial ratios help to tell us, is the company really doing well compared to previous years? Is the company really doing well compared to other companies? So it really somebody said it seems like mic placement. So just sound test, Twitter, YouTube, just put up a hand if you're hearing me clearly now. All right. So financial ratios really give us some more in-depth information about exactly how a company is doing. So as I said, the other panelist is going to go through this. Yeah. So they'll be looking at income statement ratios, balance sheet ratios, and cash flow statement ratios in some way, shape, and form. So let's just take like 2 questions and then I'll pass over to the other presenter. So that's just the basics, guys. So what I want you to take from this, let me just give you a synopsis. There are 3 main statements that we're looking at: the income statement, the balance sheet, and the cash flow statement. The income statement shows money coming in and out of the business. The balance sheet shows like the belly of the business. What does the business own, and who or what does it owe? And the cash flow statement is literally what it says. It shows the cash flowing into and the cash flowing out of a business. So, any questions? Let me just take a question or two, and then I'll pass over to the next presenter. So yes, there are fines for the submission of financial statements to the JC, not just for the quarter but annually as well, which is why, especially when a new accounting principle was introduced a year or two ago, a lot of companies were late, and there were a lot of notices saying, "Hey, we're going to be late. We're going to be late. We're going to be late." But there is a fine. I don't remember the fine off the top of my head, but it's not that huge. Oh, sorry, Mark. So the questions it said, are there any fines for late submission um of the financial statements to the JC for a quarter? Right? So yes, there are fines. All right, no problem. Okay, so so great intro. How there? We don't know if the auditors have issues with the unaudited statements. Um, any words to look out for? So yeah. So one read the. Hold on. Let me just go back to the slide. Let me answer this quickly. So if you realize over that the right hand side where you see the red arrow pointing, not at the signature, but in the last section, it states exactly what the auditors state. So for this statement, it says, in our opinion, proper accounting records have been kept so far as appears from examination of those records, etc., etc., etc. Now, I've seen statements that have said, in our opinion, we cannot confirm the validity of these statements. So the auditors will usually be very explicit. And just to give an example of what I'm talking about, you can check SSLVC's financials auditors report. So this is a good question. Is there a way to be prompted? I have 1 minute left when financial statements are out. So I kind of live on the news website. So I am always seeing when they're out. I might not be able to look at them at the same time. But I use boy, and the tech guys can tell me. I use a website that tracks the Jamaica Stock Exchange news website. So I'll input the URL for Jamaica Stock Exchange um when sorry, just being distracted a bit. Yeah, so I'll input the URL into the website, and then anything that changes on the news website that will pop up. All right, guys. So yes, somebody said they make a qualified report when there are issues. Somebody spoke about Google alerts. So somebody was asking what's the name of the website. I'll post on Twitter. I don't remember it right off the bat now. But the guy needs said news creator. Anyways, let me pass over to the moderator before she gets upset.
Thank you so much, Simon. If we don't remember anything from Simon's presentation, is that just one thing is that the financial statement shows the belly of the business. So you need to know what's going on with the company and not just make your decisions based on speculation. Good. So next up, we have April Walters, and she will be doing manufacturing companies. April is a portfolio manager at one of the largest financial institutions in Jamaica. April is a female in the industry, so big up to April doing her thing. So April, go ahead.
Um, Good evening, everyone. Thank you for that, Shante. I really admire your energy, I swear. So good evening again, everyone. So as Simon would have indicated, I'm just going to go over some of the basics as it relates to reading the financial statements for manufacturing and distribution companies, but mainly focusing on the manufacturing. And going to the next slide. One of the key things before reading a financial statement, and this is just something basic to understand, because when you're looking at the financials, they would just come out as numbers to you. And so at the very beginning, you want to actually understand what type of company are you looking at. Is it solely a manufacturing company, or is it a manufacturing company that also distributes its own products? For example, Awisinco versus Alaska Manufacturing, where, Lasco Manufacturing has the distribution arm through Lasco Distributors. And so you would also have to understand what type of business strategy do they try to employ, as well as what is the key things to pick up about the company's business strategy, as well as the industry that is operating in. I think I was this next slide, Simon. All right, so this was the slide I was referring to as well. So as I previously stated, so we have to understand the characteristics of the industry, and there's 5 basic things you can actually use as an indicator. The first thing is, what type of competition is this company operating within? For example, when it comes to the manufacturing of beverages, soda beverages, that's highly competitive locally. So that is going to be one of the key things impacting a company's financial performance and what type of revenue they're going to be reporting. The next thing is there a high threat of substitutes? Can the company's products be highly replicated with through another company, maybe through an even larger company that has a better, more efficient business model that it can operate on a larger scale? And other things to consider is that what type of relationship do they have with their suppliers? Are they heavily reliant on one key supplier or multiple suppliers? That is going to also play very well into their cost management strategy, as well as what type of bargaining power do they have with these suppliers. And the last thing is barriers to entry. Is it easy to enter a manufacturing industry locally? That I can answer and say no. They are what we deem as capital intensive. So it requires a high level of capital, meaning manufacturing equipment, as well as just funding in order to just start a manufacturing company, especially when it comes to achieving a certain level of operating scale, so that they can they can operate their business model in a way that is more cost efficient. And so the next point, and I will touch on this as well throughout the presentation, is that there's 3 things to consider when you're reading the financial report, and that is, what type of cost management strategy does the company have? Are they effectively generating enough sales using their assets? And we're going to speak on that a little more, as well as what type of sustainable business model does it have? Is it a company that, when it comes to paying its suppliers, as well as paying persons who currently hold its stock, does it rely on selling its assets? Or is it liquid enough? Does it have enough cash on hand so that it can operate and pay its suppliers, as well as pay any persons who it's owing in the short term, as well as pay its equity holders, you, the persons who are investing in the company? Can it pay you? So those are 3 of the things to consider going forward before reading any manufacturing financial statement. So the next step we can look at is, Simon would have touched as well on this, is using financial ratios as well as doing some level of basic financial analysis in order to assess how a company is performing. And the use of this type of use of financial analysis is, it basically allows you to just assess the company's past, present, and future financial conditions, seeing where there's any strengths and weaknesses, as well as what I mentioned before, understanding if there is a sustainable business model that the company is currently operating at. So three of the key things you're going to need is the financial statements, of course, the notes to the financial statements, and Simon would have touched on this previously, as well as financial ratios, which we're going to touch on some basic ones as well. And when it comes to financial statements for manufacturing companies, you will notice that relative to looking at a financial company as well as real estate and private equity, these financial statements tend to be a little more easier relative to those in terms of understanding what the business is going through, what type of earnings they're generating, as well as assisting you relative to those statements in order to understand what kind of business they're operating. So we'll start first on just the income statement, and I'll just go through some of the more key line items. So you'll have revenue, which is just basically what the company is earning, and they're just summarizing it for that period to date. So this financial statement is showing for the year ended March 31st, 2019. So this is showing for the last 12 months up until March 31st, 2019, this is the revenue that the company earned up until that point. And they usually show it relative to the prior period as well, which is 2018. Then you have their cost of sales. So cost of sales is what we call the direct expense that companies would have to experience when it comes to their direct operations. So cost of sales has to do with their raw materials, any direct labor costs, as well as anything that is directly involved with their operations. And then when you take revenue and minus it from cost of sales, you're going to get gross profit. The next line item that we can look at is also expenses. And these are just generally expenses that are not indirectly involved in the manufacturing process, and you can usually see that their name either administrative or selling or marketing and promotion expenses, and this is what we call indirect expenses. And so when you take those out, as well as taking out the direct costs that we would have spoken about regarding cost of sales, then you're left with operating profit. After operating profit, then sometimes the company may have some financial costs, and this is any cost that's relating to if the company had any debt outstanding. So if you as an individual, you have your loans, that you have your usual loan payments on a monthly basis. Same as a manufacturing company, they're going to have their interest expense as a monthly basis, but this is not directly involved in their operating activity. And so it's a line item that tends to be a little lower on their income statement relative to being at the top where cost of sales are. And then after taking that out, and of course taxation, we are left with their net profit. So I wanted to also look back again at just a breakdown of their expenses. So what I previously mentioned before was that expenses can be broken down in direct and indirect expenses. So direct expenses are just expenses that directly go into the manufacturing process, while indirect expenses are just expenses that are not directly involved in the manufacturing process. And these are just general day-to-day businesses. So I included an excerpt here that summarizes for a period some of the expenses that a typical manufacturing company would actually experience. And just looking at this, you can see, as expected, their highest cost would actually be staff costs, as well as advertising and promotion, as well as depreciation. And you're going to usually see depreciation being somewhat high when it comes to looking at manufacturing companies, because a large portion of their assets are going to be fixed assets, what we call fixed assets, or another term is property and manufacturing equipment. And when you have manufacturing equipment, especially, there is an associated deterioration, or what we call, you can say, wear and tear of these assets that the company is holding, that they also have to account for, even though it's not actual expense, meaning they're not having to pay out anything relating to depreciation. It's just an expense there that they have to account for because of whatever accounting treatment they have to apply for that period. So you're going to see depreciation being a major expense, as well as staff costs. So the next slide speaks to the balance sheet. And so what Simon would have mentioned is that the balance sheet is broken up into assets, liabilities, as well as equity. Sometimes they combine equity and liabilities. Sometimes they split it apart. There's no particular reason for it that you need to pay attention to, but it just depends on how that manufacturing company, wants to treat its statements. But for assets, you can start and say, you see what these are sources of revenue. So assets are how the company is going to generate its earnings. And it's split up further for manufacturing companies into two key categories. There's current assets and non-current assets. So current assets are the assets that can be easily changed into money. I think that's actually the simplest way to say it. You can say that these are the assets. For example, there's outright cash. You have something that is called accounts receivables that you see there. And receivables are what the company expects to receive over a certain period from either the sale of its assets or some type of sale of services, whichever one. But the company expects that it's going to get this money back over a certain period. So let's use another example where, let's say you have a car and you decide that you want to rent the car to a friend. And you tell the friend, okay, you can rent the car for about 30 days. And then at the end of the 30 days, you pay me $7,000. That automatically now becomes a receivable because you're not getting the cash now. You're getting it at the end of that period. And it's the same thing, especially with manufacturing companies that they have to employ. For example, if they're supplying a lot of products to tourism and hospitality sector, they actually have to rely, and we're going to look a little more into this later on, in terms of having to account for any cash that they're not going to receive now, but receive at a later date. And so accounts receivable is going to be a large line item at times relative to just cash and inventory. And inventory is straightforward. It's what the company has on hand to sell. And these are, again, sources of revenue or sources of income for the company. And then you have non-current assets, which are just a main example of that is just property, plant, and equipment. And those are just the assets that it's land that it's on, that it owns, any property that it currently owns that it is using in the manufacturing process to generate any type of revenue. And all of that is captured on the asset side for a manufacturing company. And so one of the key things coming from this is, how do you classify current assets relative to non-current assets? And the question is, how quickly can that asset be converted to cash? So definitely, if you know that if you have some accounts receivables that is due within 90 days, that's far easier to convert to cash relative to selling a property that can take up to a year. And a lot of landowners or property owners on this live stream would actually understand that. The next side of it is the liabilities. So we have the asset side and we have these assets that we currently own that are generating income for us. But how do we buy these assets, or how do we fund these assets? For every single asset, there has to be a liabilities, because there's no way you could have purchased that asset without finding cash aside from that in order to own it. So liabilities are just showing the funding source for those assets. And it's similarly split, like the asset side, in terms of current liabilities or non-current liabilities. So for current liabilities and even for current assets, these tend to be within 1 year or less. Actually, that's the standard. 1 year or less, it can be easily converted to cash. Or if it can't be easily converted to, at least within that one period. So if you know you have some accounts payable, and accounts payable is just essentially for manufacturing companies, whatever amounts you owe your suppliers. That's usually forming a large part of whatever accounts payables. So if you know that you are supposed to pay your supplier for a product and that is within a period of 90 days, then that is going to be a current liability. Now, if by some chance the supplier says, hey, you can pay me back within over a year, maybe next year, March, then that is no longer a current liability. That's a non-current liability because it's over a year. It's not something that you have to worry about for now. And so businesses will classify it as a non-current liability. At the same time, any sort of debt that the company owns that it currently is not paying back or not due to be repaid within 1 year is also a next common long-term non-current liability that you will observe. So the question here is again, does the company have significant short-term obligations that reduces its ability to pay shareholders? And this is something that we have to pay attention to as investors. Because you know that at the end of the year, a company has to announce whatever dividend payment to you. But if you look on their financial statements and you look on their balance sheet and you see that their current liabilities is much higher than their non-current liabilities, so within the next year, that company has to pay back whoever it owes money to before you. And we're going to also look at the capital structure a little later on so you can understand that statement even more. The last thing is equity. And equity is in its simplest form just showing what is the net worth of a company after all assets are sold and debt and liabilities are repaid. And the simplest formula is assets minus liabilities is equal to equity. And I repeat that again. Assets minus liabilities is equal to equity. And equity represents one, what the level of ownership the company's owners have in it. And sometimes this is actually where it's even capturing you as an investor. Where you see share capital, that is actually representing the owners of the business, how much capital they have contributed to this business. And the next key line item in equity, under equity, would be retained earnings. And these are just earnings that the company has chosen to not pay out as dividends and sometimes carried forward. So just to speak a little more again on accounts receivables, and this is important because when it comes to manufacturing companies, maintaining a certain type of turnover, or I can say ensuring that they're being paid in a timely manner, is very important to the operations of a manufacturing company. That's because they have to receive this money in order to put it back into their business, because these are capital intensive companies and they require a certain level of cash and funding in order to maintain their business operations and in order to make sure they can pay their suppliers as well as pay whoever they owe as well. So here is an excerpt, and this is something I picked up from the notes to financial statements. And guys, it's actually very important reading the notes to financial statements, because it's going to answer any questions that you may have. So this just shows the credit exposure. It's called the credit exposure for trade receivables. And this is from an actual company listed on the Jamaica Stock Exchange. Now here you see that a large portion of their as receivables are just owed to whatever customer sector is in Kingston and St. Andrew. They break it down by geographic regions. But you do see there that they actually still also have somewhat of a, not as large as others, but a relatively large exposure to hotels and restaurants. And again, speaking back to my point where they now have to ensure that these persons are paying them in a timely manner, so they are getting the cash back to ensure they're operating their businesses. The next thing is also the age of the receivables. And another way to express this is when it comes to their accounts receivables, what is the time expected? What is the time outstanding that the company has not gotten back its money? And this is very important, because if a company is not selling if a company is selling its products and they're not receiving the cash back within even 30 days, 60 days, or even worse, over 90 days, then that's a big problem for that manufacturing company. They're not getting the cash back at the rate that they're selling. And that means that even though they may be reporting a profit, when you look on their cash flow statement, and we're going to look in that a little more too, you're seeing that the company actually does not have enough cash on hand. And that's going to be a problem, because if the company doesn't have any cash on hand, it can't pay you any dividends at the end of the year. So it's very important to actually pay attention to that simple factor when you're looking at a manufacturing company. Is this company ensuring that whoever owes them money is paying them back in a timely manner? And now I go into the cash flow statement. So we looked at the income statement, we looked at the balance sheet, and the next thing now is the cash flow statement, which just shows an overview of all the cash inflows and outflows. So an inflow, think of it as as an individual, your pay every month. That's an inflow for you. An outflow for you is you paying your electricity bill. Same thing for a company. Their cash inflows and outflows are just shown in this statement. And actually, I think the cash flow statement is actually the most important statement, because what I think it is that it debunks a lot of the fluff that you can see in the balance sheet and the income statement. And let me tell you why. If the company, and even just speaking back to my point about the accounts receivables, if the company is saying, oh, we're generating all this revenue, so they're earning like 2 billion in revenue and net profit is nice, and then you look on their cash flow statement and all you're seeing is negative, that's a problem. That is a big problem. That means that company is making sure that, yeah, we're reporting to these shareholders that we're making all this money, but when it actually comes down to cash and when it comes down to your dividend payments, you're not getting anything. You know why? Because the company doesn't have any cash. And so the cash flow statement is actually is probably the most important statement to pay attention to. And then it answers two important questions. Does the company generate enough cash from its operations to pay for its new investments? Or is the company relying on debt to finance your activities? Now, if you see a company announce that, hey, we're issuing this amount of debt or we're taking up this amount of loans, and you're seeing that the company is spending a lot of time expanding their operations, buying up property, but they're doing this by borrowing more. And then you look on their cash flow from operations, and then that's the next section that we're going to look at. You're looking at their actual cash flow, and you're seeing that it's negative. That means that the company is not sustainable. This is a company that is relying on just borrowing and is not focusing on improving whatever inefficiencies are happening in its business in order to generate money. And this is a very important question to answer before you invest in a company. Is this company operating at a sustainable level, or is it just a company that is just standing by? Because you have companies out there that just live in hand to mouth, So the next question is, does the company pay its dividends to shareholders using cash generated from its operations or selling assets or issuing debt? And you may have heard of a company recently, actually, that you may have started hearing they've been selling down assets to fund whatever daily operations. When a company has to resort to selling asset, that is never a good sign. When a company is not able to generate enough cash, real hard cash, in order to operate, then that is a problem. And that is why, again, the cash flow statement is the easiest way to spot any potential financial distress that is happening. So just an overview of the cash flow statement. It's broken down in operating activities, investing activities, and financing activities. Operating activities, cash flow from operating activities is just showing the cash inflows and outflows from day-to-day operations. Cash inflows from any sort of sales and receivables, as well as cash outflows from direct or indirect expenses. And a negative cash flow from operations means that the company is paying more out from its expenses than it is actually getting from inflows. And again, that is something to pay attention to. Cash flow from investing activities shows the cash inflows and outflows from any sort of investment activities. And what we mean by investment activities is just the buying of assets that are going to be generating additional revenue for that manufacturing company. For example, the purchase of land, property, or equipment. That is what for a manufacturing company is called an investing activity. And what you're going to notice from the other presenters is that this is going to differ across companies, because an investing activity for a manufacturing company is going to be different from a financial company because of just the nature of their business. And then the last thing is a cash flow from financing activities, which is just a cash inflows and outflows from borrowings and debt repayments. And again, this is something important to pay attention to. If it's negative, that means that the company is borrowing more than it's actually repaying in its debt. That means that this company is so heavily reliant on borrowing from other persons that it can't service its own debt. And you can even think of it yourself, is that why would you want to invest in a company, or would you lend money to a friend who all you see that friend doing is just borrowing and not paying them back each time creditors are call them and them can't answer because them don't know where the money coming from? Again, that is not sustainable. And those are the things that cash flow statement actually shows you. And the cash flow statement is related to the income statement and the balance sheet as well. And it explains a lot of the movements, a lot of the things that may not make sense to you when you look on the balance sheet. You can look on the cash flow statement, and trust me, the flat cash flow statement is going to explain it. See Simon here. Somebody may be asking which company this is. I will verify that because I'm using multiple companies as an example, and I don't want to say the wrong company. However, just going into the next point. So some of the qualitative factors to consider when reading a financial statement for a manufacturing company. So there's a greater risk if, for example, this manufacturing company's revenues are tied to a single customer. Why are you going to invest in a company that 80% of their revenues is coming from one single buyer? And this is actually something that they provide in the annual report. A lot of companies actually disclose it because it is something that is material. Are their revenues tied to a single product? You need to understand that the revenue figure that you're seeing on the financial statement is not just a number. There's something tied to it. Are they relying on just a single supplier? We understand what's going on right now with coronavirus. If anything happens to China, a lot of manufacturing companies are hit. And then when it comes to any increased costs from their supply side, then you have to think about, is the company in a strong financial position to stomach these costs? Are they going to have to pass it through to their customers by raising prices? And is the company export oriented? So a lot of companies, you are going to see manufacturing companies are actually more projecting towards being more export oriented. And that's actually a good thing, because then at least, there's some diversity in their revenue lines, and you're understanding, that if there was anything happen to the local economy, then this company is going to be more resilient. And then there's other things to consider as well, but I digress. So I'm just going to run through some of the ratio analysis, some basic financial ratios. I'm quite over my time, guys, so bear with me. So the objectives of ratio analysis is just to standardize the financial information for comparative purposes. So you're going to look at the financial statements. You're not going to really understand the business, because sometimes you don't realize, again, and not to say there's anything malicious behind it, but a lot of these companies are going to present their best foot forward. Now, you as the investor, it is your responsibility to sit down and actually dive deep into these numbers and ensure that this company is not presenting their foolishness to you. And the financial ratios, and some simple financial ratios as well, are going to be important in understanding this and understanding even how this company performing relative to another. So there's 4 categories of financial ratios. You have profitability ratios, liquidity ratios, efficiency ratios, leverage, and solvency ratios. So I'm going to start with profitability first. So the first thing is, how is the company profitability? No, or what I can say is, a company's profitability is not just it's her earning the most amount of money. It's understanding more about the business in terms of how it is managing its costs and what type of profitability margins it is generating. So the 2 key things you need to know is gross profit, which is revenue minus its direct expenses, and direct expenses are cost of goods sold. And then net profit, revenue minus direct expenses minus indirect expenses, and the indirect expenses are not directly related to its business operations. So when it comes to the gross profit margin, the higher the better. And this can be simply explained with, if a company has a gross profit margin of 45%, for example, that means for every $1 of sales or every $1 of revenue it generates, it actually has a gross profit of 45 cents. Or you can say that means that 55% of its profit, of its revenue, is eaten away by just its direct costs alone. So the higher the better, because if it was lower, that means that immediately before you even go into the other expenses, the company's revenue is being wiped out by its direct costs. And that's a problem. I'm so sorry, guys. Unfortunately, I'm having some computer issues. Simon, I'm going to ask if you can just maybe switch over for me while I try and deal with the computer. I don't want to interrupt the presentation.
Okay, April. Okay. So let me just complete this. Yeah, man, April are going good, man. April are going good. But April, the way you fire up the place, but no one hear my voice again. Anyway. No, but April, you have time, man. You can go on,
All right. I'll just skip over. So the net profit margin again. So the net profit margin, and this is an important point, guys. If you see a big difference between the gross profit margin and the net profit margin, that again speaks to the fact that the company is not managing, even though it may be managing its direct costs appropriately, its indirect costs are again eating away its profits. All right, give me a second, guys. I'm going to switch over. Simon, you may want to just go through the next slide for me while I switch over.
All right, will do, guys. I don't want to blame Flo or anybody, So let me just go kind of slowly. Yeah, man, Rory. April is always here, so she'll be here with us. All right. So April was talking about the net profit margin. So it takes into account both. So basically, the net profit margin is really a total profitability that's in your income statement divided by the total sales. So, for example, if a net profit margin was 20, comes out to be 20%, that means that the company, for every $1 of sales that it makes, then they make the net income of 20 cents, basically. So the net profit margin is a good way to compare the profitability of a business over time, and you can compare the net profit margin with the net profit margin of other companies as well. So it's most commonly expressed as a percentage. Yeah. So if you look at this slide here, so it's probably a good time that April is switching over because she left a little exercise. So I'll be watching the comments. Um, so based on this slide here, hold on, let me put you back in full screen. Based on this slide here, guys, which company would you say is the most profitable? So if you realize the net profit margin is that number down here, so 2.9 billion in this case, divided by 28.4 billion for company A. So that's company A, which is 10.3, company B, which is 5.7, and company C, I believe April is back. April, you hearing me?
Can you hear me?
Yeah, man, you're good now. So
Okay, I'm
basically
so sorry.
on the exercise. Sorry, guys. You can go through now.
Okay, I'm on my phone, so I apologize for any type of feedback you may be getting. Um, so we're on the slide that is oh, okay, so we're on the exercise slide now. All right, so just diving back into it. So the last point that I would have made was just ensuring that when you're looking at these companies, you're also looking at how they're managing their costs directly. So this slide that I brought up, and I know that I think Simon may have showed the vertical analysis slide before. And when we're speaking the vertical analysis, or by simplest terms, it's actually a very easy way to calculate the profit margins without having to do it one by one. And the most commonly used is one, you're expressing a line item on the income statement as a percentage of revenue, or for the balance sheet, you're expressing it as a percentage of the total assets. So on the slide that Simon is in now, the first thing you see is that which company is the most profitable. I mean, of course, 2.9 billion, you're seeing that straight there. You're saying, boy, that company here, 2.9 billion, obviously the most profitable company. So then we go to the second question, which company has the best cost management? And let's start with their direct costs. So immediately, cost of sales, company A, you see they have 62.9%. Company B, 66.5%. Company C, 63.6%. So immediately, company A has the best cost management of its direct costs. Company A might be a more mature company. When it comes to mature manufacturing companies, especially, they tend to have better cost management procedures in place relative to a company that may be a little younger, maybe focusing on aggressive growth. So that tightening of its cost management may not be there as yet. And that is reflected here, when in fact company A is the more mature company. And then now let's go back down to indirect costs. So immediately you're seeing a wider disparity now when it comes to their indirect expenses. And you can see, just looking at company B, that it's a prime example of, yes, all right, you manage your direct costs, but when it comes to your indirect costs,
look at what happens, the difference between their gross profit margin and their operating profit margin. And their gross profit margin, remember the formula is gross profit, the figure, as a percentage of revenue, which is a 33.5%. And then when you go back down and you take out all of their indirect expenses, falls to 7.6%, the lowest amongst the others. So again, company D might be a less mature company that is pushing towards striving, maybe capturing some area of the market, and so cost management may not be the most important. But you see here that it's very important, the use of just looking at their margins in order to assess how effective this company is operating. Because just looking at it, everything seems fine, but then when you dive down deeper, you see that you can compare what is happening across each company. And these are real company figures, by the way, straight from Jamaica Stock Exchange. And then when you reach their net profit margin now, you actually see where it even goes even lower to 5.7%, while company A and B, especially company C, are doing quite well. So even though company A is the most profitable company, company C has the best net profit margin. And remember, guys, it's out of this net profit you are getting your dividend payments. So again, very important to pay attention to that. The next thing I can cover is just the horizontal analysis, which is just simple change year over year or change over a certain period between one period to another. So if you want to compare 2019 to 2018, the formula is there, and it just indicates where you can just take the difference, and whatever difference, you divide it by the old, or what we call the base year, and that derives the percentage change. And this can be applied to year over year or any period. So the last two profitability ratios are just return on assets and return on equity. And return on equity is especially important because remember, you guys are the equity holders. Remember when I mentioned on that type of the balance sheet where it speaks to shareholders' equity, and I said the share capital represents the owners of the business. You are using this ratio to calculate from their net profit relative to their total equity, how much are they returning for each period. Because remember, it is from your net profit you're getting paid by the business. So the next thing now is liquidity. Liquidity, basically, when you think of liquidity, just think of ready cash. What cash is, of course, the most liquid asset, but there's also things, and what we had spoken about before, what does a company own that it can readily convert to cash? So one of the most important liquidity ratios we're looking at is current ratio. And that just looks at the relationship between current assets and current liabilities. I remember what we had said. Current assets are assets that can be readily converted to cash and they expect some type of inflow from that within 1 year. Current liabilities are any obligations, whether to their suppliers or to any lenders, that are due within a year. And the importance of this is that you want to know, over a short-term period, can this company adequately cover its payment obligations over the next year? So therefore, a ratio of 5 would indicate when you divide current assets over current liabilities, and let's say, for example, you get a ratio of 5, that means that the company, for every $5 of current assets, it only has to cover $1 of current liabilities, which is good. That means it's overcovered. That means that it can safely operate. So let's say if it fell below 1, then that would suggest that if it had a ratio of 0.75, that means that the company only has 75 cents in current assets available to cover every $1 of current liabilities it owes. And that means that they are more in trouble of paying their short-term liabilities. And remember, guys, when it comes to manufacturing companies, their short-term operations, yes, it's very important in terms of their sustainability and longevity, but their short-term operations are very important in order to maintain their business model. So the next ratio is just a quick ratio, and it's just the current ratio, but you take out the inventory. And we take out the inventory because not all the time is inventory as cash ready as other current assets. So the ratio is just making sure that it focuses on what are the most easily converted. Not to say that inventory is still not liquid, but it's just a ratio that wants to take out inventory and focus on what is even more easily ready to be converted. So the next thing is the efficiency ratio. And the efficiency ratios are extremely important for a manufacturing company or a distribution company, because it's measuring how well is this company actually utilizing its assets to generate revenue. And remember, what are the key assets for a manufacturing company? Their equipment, their inventory, their accounts receivables. Those three things are extremely important, and the company must be generating revenue effectively from it. So the first thing that you can look at is the asset turnover ratio, where you just take their revenue for a period, you divide it by their total assets, and it's basically showing you for each unit of an asset that they have, they are generating this much in revenue per asset. And of course, the higher the better. Now, if it's low, that means that you're investing in a company that it has all of these assets and it's not doing nothing, not generating not enough money to cover whatever expenses it has. Inventory turnover ratio, again, this is just looking at cost of goods sold over inventory. And it means that the company, whatever inventory it has to pay for each one. So remember, when it comes to inventory, it's going to be an asset, yes, but each asset is funded by some type of expense. So their cost of goods sold is factoring in the cost of this inventory, their raw materials. Now, it don't make sense that you're spending on this inventory and building up your inventory, and yeah, the company has a high level of inventory, and then you're thinking that, hey, this company has a whole lot of inventory. When you look at the balance sheet, must be good. No, because when you use this ratio, you can see if that company is actually selling its products. But they have some products on their oh, sorry, I got distracted. They have some products and it's not being sold in a timely manner. It's there for 90 days, 180 days, doing nothing. So when you're looking at this ratio, it's very important, because that means they have good and effective inventory management. Low turnover means that there's slow growth in their actual sales. And then it calls into question, is the revenue being reported by the company even fully representing what the actual business is experiencing? Receivables turnover, and guys, I had stressed receivables before because it's extremely important when it comes to manufacturing and distribution companies. For each revenue that the company generates, you have to understand whether it is what we call a cash sale or a non-cash sale. If it's a cash sale, that means the company gets actual cash coming in, and you're going to see it in the cash flow statement as well. But if it's non-cash, that means it's a receivable. That means the company, by accounting standards, can actually recognize it as a sale, but it's not receiving any cash for it. And then it becomes important, because then the company is going to have to focus on ensuring that they are getting cash in to cover whatever expenses and obligations that they have. Now, if you have a company that has a high level of accounts receivables, that's a problem, because that means that that company is not making sure that it's getting back the revenue, the actual cash that it's due in a timely manner. And that's why I showed you previously in the prior slide the age of receivables, because that's very important. If it was the other way around, so that company was a good company, its age of receivables was less than 30 days. But let's say if it was the opposite, let's say that over 90 days was significantly higher, then that could actually mean a sign of some type of financial distress of the manufacturing company. The last one here is just leverage ratios. Leverage and solvency, it just speaks to what type of sustainability does the business model currently have. It speaks to one, its ability to pay its debt, but as well as just answer the basic question, is this company going to be in operations over the next year? Is it just working hand to mouth? Or is it going to actually have a strong and robust financial core that it can continue over the next year? So on the next slide, and I had spoken previously to capital structure, and I want you guys to take a very close look on that. Look on where common stock is. You are all common stockholders. You are all at the bottom of that capital structure. If there is anything that happened to a company, if the company decides, say, yo, we can't operate no more, we're gonna have to sell out everything. If it sell its assets, if it sell its business, if it all sell the people, you are going to be the last person that gets anything. And therefore, that is why, again, it's very important to pay attention to what is its cash and cost management strategy. Does the company have a lot of debt? If the company is relying heavily on borrowing, that is actually putting you in a worse position. Because if you've noticed on the income statement, interest expense or finance cost is on the income statement, meaning they have to pay their debt. There's debtors and their creditors before they pay you. And there's a reason for that. So therefore, if the company has too much debt, or if the company earnings are putting it in a worse financial, or if the company's debt is putting them in a worse financial position, you as an equity holder should not invest in that company, because at the end of the day, that company is not going to be looking out for you. That company is going to be focusing on the person that they owe first. So assessing the debt ratios, even though we are equity holders, is very important, because their debt levels or their leverage ratios impact their ability to pay you any dividends, for them to operate as a company in the long term. And a lot of companies have a whole lot of debt. And when it comes to dividend time, them have to scrummage and find some way find cash to pay you. So the very important one to look at is debt to equity. And that debt to equity ratio is just the leverage ratio that shows what is the proportion of equity and debt that is used to finance a company's total assets. ROA and ROE, again, are just showing, we had already gone over ROE and ROA, but when it comes to ROA, again, this was another profitability ratio that we had looked at. But when it comes to your ROA, your return on assets, if a company issues more debt, that actually impacts, again, the return to equity holders or the return on assets, because when you issue more debt, you increase your interest expense, because the interest expense is a line item or finance cost, like what we saw on the income statement, and that lowers your net income. And remember, again, where do you get paid your dividends? From your net profit. And the last point, guys, is just going over some of the limitations of ratio analysis. So ratio analysis is more effective when assessing a company performance over a period of time. So a lot of analysts or persons, when you hear them speaking and doing any type of assessment, they usually look at a company over a certain period of time. Looking at just a company's performance for 1 year is not going to necessarily give you an adequate picture. Even if you do financial ratios, you need to be over a certain period of time. Also, accounting practices can differ across companies. So whatever accounting treatment they want to usually it's IFRS 9. But in some other cases, it can be, there's another one, US GAAP. And that is going to impact how a company actually reports its earnings. And so if you are comparing a company with two companies with two separate accounting treatments, you may not be adequately representing their performance by just doing financial ratios. And then there's some other points as well. It's difficult to interpret at times. Some industry ratios may not be desirable, and seasonality, of course, are going to affect earnings and consequently financial ratios. So guys, I know I went a little bit over time and I had some technical issues. I do apologize. However, I hope I could give you as much information as possible. And I'm just going to let Simon and Shanti take it over from here. Thanks again.
Hold on, April. Hold on. April, you there?
Yeah. Yes, I'm here.
Yes. So, why is a very passionate somebody saying it almost seemed like April start getting mad at some of the companies. Like, why you don't have enough cash? Why you don't have enough cash? You know, but excellent presentation, April. And let me just reiterate that this video will be saved on YouTube, so you guys can take a look at April's passionate presentation after this. April, we're going to do a few minutes of Q&A, okay?
Yeah, man, sure. Oh, I thought it was at the end. Yeah, man, sure.
Oh yeah, so you know, guys, April managed couple 100 billion, you know, so she's a very busy woman. So let's go. What are the questions that you guys have for April? Okay, so Fuzzy Brown 91 said when cash flow from investing. Oh, he wanted you to kind of reiterate when cash flow from investing is positive or negative. What does it mean? April? Hold on. Sorry, April. You just dropped off again. But Fuzzy Brown 1981 was asking when cash flow from investing is positive or negative, what does it mean?
So when it is positive, that means that the companies actually may have done some sale of property or sale of any actual real assets that it owns, or any real estate or any equipment, and that is now a cash inflow. So it can be negative now if during that period the company may have spent even more on, for example, any sort of expansion activities. So it may not necessarily be a bad thing unless you see over period of years that the company is aggressively focusing on spending more and expanding relative to its other cash flows.
Okay, understood. The Guyanese said, what's the difference in the receivables figure that's in the balance sheet? I think that's balance sheet, Chike, versus receivables, the receivables figure that's in the cash flow statement.
All right, thanks, Daganese. I hope I said that Daganese. So that's a good question. So the accounts, remember the cash flow statement, and I guess I should have pointed that out. The balance sheet is showing things at a period in time. So meaning, as at March 31st, 2020, this is how much accounts receivables the company had outstanding. The cash flow shows the movement in balance sheet items especially. So when you see accounts receivables on a cash flow statement, that is actually showing whether it was an inflow or an outflow for the period. Now, if you see that if you see accounts receivables moving on the cash flow statement, for example, sometimes it can just be that the company is actually being repaid its accounts receivable. So it's not the total amount outstanding, it's the movement in it. And you should actually pay attention to that, because that shows then that is the company, if it's a very small figure in terms of a small negative figure, then that means that the company, a small positive figure, then that means that the company is not getting as much inflows from payments that they're supposed to be receiving versus any outflows. So if you also look quarter over quarter, for example, and you see that their accounts receivables haven't moved, that should be reflected, even though they don't usually publish a quarterly cash flow statement, but that would be reflected in the cash flow statement, the movement. But then if you're not seeing much movement, then again, that is a problem.
Okay, I understand. Thanks, April. I hope the Guyanese got that one. Um, Shaniel Blake, I'm just taking two more guys. Shaniel Blake asks if a company chooses to retain earnings and hence no dividends are paid out for the year, is there a time limit in which companies have to stop retaining and they have to pay out dividends to shareholders?
So the best of my knowledge, no. But that's just quite a selfish company. And those are the type of companies you should not give your money. If you're seeing that a company is probably saying they're not issuing any dividends this year, that year, and they're just going to be using whatever cash available to put that back into the business. Yes, that's good that they're investing back in their business, but it's not good for you as a shareholder that they're not issuing any dividend payments. However, to the best of my knowledge, no, there is no limit. A company does not have to pay you dividends, and that's actually probably the more greater question. Does a company have to pay dividends? No, they don't. They just
Okay.
usually, for consideration, do it.
Yeah, and I mean, what I would also add is that this may hurt their sentiment going forward. I mean, you are much more blunt than I am. I just basically said that. So the last question, it's not Dr. J.A. asked, are companies required to publish these ratios? Sorry, guys. Yeah, April, you hearing me now?
Yeah, man, I can hear you.
So it's not Dr. J.A. asked, are companies required to publish these ratios that you spoke about?
No, and oftentimes it would be really not in their best interest to do that. These financial ratios, you can pick. I'm being very blunt. It would be more in your best interest. And there's a lot of companies and dealers who actually publish research reports, very excellent and detailed research reports that actually use these financial ratios. And you can do them for yourself. I mean, that's why I want to teach you guys here today. But no, these companies do not have to publish these ratios. Um,
All right, I'll take one last one. Okay, so well, all right, two last ones. Sorry about that. Two last ones because I think these two are important. Mark Gale, Mark, big up Mark, said how many Jamaican companies report per gap standards? That's I think US gap.
I Yeah, I don't know of any company because they would have to be based in the USA, if I'm correct, Simon, to want to adhere to US GAAP. The thing about it is that sometimes a company can opt to do a different accounting method because it actually can either increase or decrease certain line items. However, there's some standards in place that actually try and prevent this type of manipulation. So obviously, if you're going to, I think, change out your financial statement for 1 year, you have to do it for the prior period as well in terms of changing your accounting standard. But I don't think that there's any local company that's issued that would be reporting under US GAAP. Probably the best example to show is picking up like maybe Apple, any
Okay.
US based company, and their 10K statements to look at that. But I think for the most part, most Jamaican companies are under the IFRS.
Okay, and last, well, I wanted to make a point. April, guys, April made a very good point a while ago. I want to repeat it again. It's very important to do your own homework, especially as it pertains to ratios. As she said, especially for companies that are not performing, it is not in their best interest to show you these ratios. Okay, but it is in your best interest. Her words. Anyways, the last question, April. Um, Devon Maxwell asked, why do some companies have depreciation on the income statement while some lump it into SG&A expenses?
I mean, I don't, to the best of my knowledge, I can't pick up why, other than maybe just for reporting reasons. They may just choose to separate it versus lumping it up. But again, that's your responsibility. If a company is not presenting the information in a way that is easy for you to read, then is that really a company that you want to invest in? Are you going to have difficulty with this company going forward? I mean, I personally admire companies that present very accurate and detailed financial statements, not just the copy and paste, or sometimes them just are lean. I can't understand that. So when it comes to looking at a company that may decide whether to lump up or break down its expenses, I mean, I think that is really up to the company, but there's nothing preventing them from doing it. It's just giving you a little more work.
Okay, all right. Thank you so much, April. Let me just pass over to the moderator.
Yes, thank you, April. Awesome presentation. I must admit, I've heard some of these things before, but the way how you put these things together, it really pulled my attention. Awesome job. And if you're just tuning in, this is Stocks on the Rock. This is the Financial Statements Edition, hashtag SOTR. Please visit the web pages. We are up on Twitter, as you know. We're on YouTube. Where else are we on, Simon? We're on Twitter, we're on YouTube.
YouTube and Twitter for now.
For now, and we'll be expanding soon. So next up, we have Julian Morris, and he'll be looking at the financials for financial companies. Julian is an analyst and the founder of Wealth Watch JA. So he's not only in the industry, but he is an enthusiast as well, and we're super excited to have him speak. Go ahead, Julian.
Good evening, everyone. I'm happy to be here. All right, Simon. So, because April did such an immaculate job, I will be very brief in my presentation. So we can just jump right into it.
Julian, is that a pun? An immaculate job?
Yes, it is. For sure. All right, Simon, we can go ahead. All right, we're going to look at financial sector companies. So we want to identify the type of financial sector companies, whether it is a insurance firm, a microfinance firm, or a financial conglomerate with multiple segments. And that would frame how we understand the characteristics of the company's business segments. So does the company, for the case of a conglomerate, for instance, does it have a wealth management arm, a banking arm, and an insurance arm? A good example of this would be an NCB Financial Group. So that company has more than one moving parts. You can't necessarily put it in a box to say, well, it is a bank or it's just an insurance company. We have to look at it holistically. Then the next thing we have to consider is understanding the company's business strategy. And this is usually mentioned in the MD&A, which is a management discussion and analysis. The importance of the MD&A is that it frames the numbers and puts them into context. So separate and apart from looking at the numbers in the financial statements and verifying those numbers with the notes, would have to go further to look at the leadership's explanation of that performance. So if we notice that a particular company has a certain change in its financial performance, say a big dip in the cash levels, we might look at the MD&A and see an explanation for that change that might not be in the notes. And the next thing we want to look at is examining the competitive advantage of the company relative to competitors. So what is the cost management strategy of the firm? What are the assets under management of that firm? So size is very important with financial companies. That's because smaller firms might not be able to take advantage of certain opportunities that larger firms might be able to seize. But the flip side is that smaller firms might be more agile, while larger firms might not be as quick to seize certain opportunities. So we want to look at whether or not the company is in a niche, or is it that they are multifaceted conglomerate. Then we want to look at liquidity, right? Greater liquidity levels enable greater risk taking and greater flexibility. And we also want to assess the company's track record / expertise / experience. Now that is the weapon of each financial company. That's the truth, because it's really a business that has a lot to do with know-how and expertise. So that is where many firms can actually get their edge, having the talent that has the experience and the track record and so on. So these are the main income sources for financial firms. First, we have fee income, and fee income is generally produced by general business activities, including corporate transactions and professional services such as advisory fees. So let's say, for instance, a company wants to raise some money and they'd like to do it by means of an IPO. So the company would approach the investment bank and say, look, I want to build out my factories and to update my equipment. Or in the case of a financial firm, they might want to go into a new market and they want to raise fresh capital. So they go to the investment bank, who will then tap its client base and allow that company to raise the money, and they will charge a fee. So that is how fee income comes into play. Another example of fee income is charging fees on assets under management. So for instance, when a company builds its assets under management, every time it grows its investor base and investors invest more capital with them, they will be able to charge a management fee on those assets. So moving from fee income, we're looking at interest income, and this is generated by loans that are originated by the company or securities held by the firms. So a financial entity might have bonds that it owns. Yes, companies do invest too, not just individuals. They might have bonds on their books, and those bonds might be earning interest because the company has cash resources and they want to generate a return on those cash resources. So they will have bonds on their books that might be earning interest income. Or when a retail lender lends to their clientele and those clients pay them back in the form of interest, that is also seen as interest income. Then finally, we have gains and losses on sale of assets. Now, when companies, financial entities have trading divisions, and those trading divisions execute their trades, whenever they make a profit or what is called a spread, we book that as a gain or a loss on the sale of financial assets. Now, types of financial sector firms. These can include microfinance entities. These are small-scale lenders targeted at retail customers or small business operators. The loans are usually short-term and they usually have high interest rates. And those rates typically price in the risk, because if a microfinance entity is lending to a smaller client base, meaning that these borrowers have less assets to use as collateral, for argument's sake, or you're taking out unsecured loans, it means that it's higher risk. So they have to price it in with a higher interest rate. And next, we have investment banks. These firms are focused on raising funds on behalf of corporate clients. We use the IPO example just now with the instance of an investment bank. They also raise money via bonds. These firms often manage funds on behalf of clients as investment managers to generate returns so they can meet their financial objectives. For example, pension fund management. So let us say, for example, there's a wharf, and the wharf has its employees contributing to their pension, their pension, right, on a monthly basis. What they'll do is hire a third party, which is an investment manager, to manage those pension contributions so that when it is time for the clients to get their pension payout, there'll actually be something to pay out. So it's important for the investment companies to generate a return on behalf of their clients in the form of pension fund management, for example. And next, we have insurance companies. Now, insurance companies are focused on providing a future payout based on a specific claim under specific conditions. This payout is funded by regular payments called insurance premiums. And these companies can be life insurance companies, health insurance companies, or general insurance companies. Now, general insurance typically embodies insurance that doesn't have to do with life or health insurance. So for example, motor vehicle insurance, property, things that have to do with physical assets and not necessarily a human life are typically classified as general insurance. Then we have the commercial banks. These are focused on using customer deposits to generate loan products to clients. And finally, we have financial conglomerates. And these typically have multiple segments and provides value as an integrated group of companies. Now, so now we'll be looking at the financial analysis, but at a high level, we want to assess the firm's past, present, and future financial conditions. And these tools are used to find a company's financial strengths and weaknesses. And the primary tools, as mentioned before, are the financial statements, the notes to the financial statements, and the financial ratios. And we want to compare these on a peer-to-peer basis where possible, so we can put the numbers in context. And these statements, as mentioned before, they include the income statement, the balance sheet, and the cash flow statement. And they all have a unique relationship with each other. But of course, April, she did an excellent job of doing the breakdown and understanding the relationship between these. Now, a key area to focus on for financial entities is net interest income. And the calculation is interest income minus interest expense. Now, this is the difference or the spread between funds borrowed by financial institutions and lent by financial institutions. So let's say a firm, they borrow at a rate of 5%. Yes, financial entities, they borrow quite a bit, right? Because that's their weaponry. That's what they use to drive their operations. That is their ammunition, so to speak. So they borrow at 5% and they lend to their client at 15%. Now, the net interest income in this case, and we're just speaking purely hypothetically, that would be the difference between the 15% and the 5%. So that 10% would represent what the company makes. Next, we have the net interest margin, which would be the net interest income divided by the interest earning assets in the company. Now, the interest earning assets of the company can include some of what we mentioned before. These would be liquid securities. These would include the loan portfolio that would be applicable to that specific company. And we want to see how that package of interest earning assets are yielding net interest income. Because what we're doing is putting these assets to work. So let's say, for instance, we want to look at an agricultural example, just at a high level. Now, we plant a seed so that the seed can generate fruit. Now, the seed itself would be the interest earning asset, which we put to work in the earth, and that return would be in the form of the net interest income. And that's how we gauge how well a company is using its assets and how the assets are performing over time. These are highly influenced by interest rates in the economy. So a lower interest rate environment will tend to reduce interest margins over time. Interest earning assets, as mentioned before, they include fixed income securities or the loan portfolio. Now we want to look at key items for the income statement. Now, this financial statement is actually one for a company that has multiple segments. It has a segment that has interest income, it has non-interest income, and it is broken down based on the business line. Now, we want to look at the income and expenses by segment. So we have interest from loans and deposits with banks, then the interest from securities, and that will give you your total interest income. Then we adjust it for the interest expense to get the net interest income. Then after we pass all the categories of interest income, we want to look at non-interest income, which would include fee income. Now, after looking at the net interest income, and adding it to the fee income, we would get net revenue. So that's how we start looking at net revenue for financial entities. We want to combine everything that earn interest income and everything that earned fee income. We combine that, then we get the net revenue. After we get the net revenue figure, we start to adjust it for the operating expenses, such as salaries, your property expenses, and so on. Then we'll get the profit before taxation. Then we adjust it for the taxes that are applicable to profits. Then we arrive at the net profit for the firm. So next we want to look at the expense breakdown, because what we can do is to look at what portion of the expense breakout is carrying the most weight. Because we might see, for instance, several line items right now, but we need to know what portion is carrying the most weight for operating income, for operating expenses, sorry. So right now we have salaries, pension contributions, and other staff benefits. So we're seeing that staff costs make up a great weight of the operating expenses. And this is why, more often than not, when firms come under stress, financial firms in particular, one of the first areas they look at in terms of adjusting their cost structure is to do layoffs. It's not because they're wicked or they don't love people, but it's because sometimes when we look at the cost structure, we have to look at where is carrying the most weight and how we can be efficient in making the most impact with the resources that we have. Then we want to ensure that the expenses are put into context. So for instance, we can't look at staff expenses the same way we look at utilities, right? Reason being, for a financial entity, it's very hard to value talent, for example. There are persons who are of the school of thought that high quality talent is expensive, and I believe in that school of thought more often than not, because when individuals become more qualified and they have more experience, they're going to command a higher salary. But if you were to look at a piece of computer equipment, you wouldn't necessarily apply that level of reasoning, because a machine is different. It's different in terms of looking at it straight for the numbers. Okay, this has better features, this has better characteristics based on the specs, and we can get it for cheaper. So we have to remember to put expenses in context, both qualitatively by looking at the weight, quantitatively by looking at the weight, and qualitatively by looking at expenses by nature. Now we want to look at the segment breakdown. So we mentioned previously that this firm has multiple segments. The thing with this kind of scenario is that we want to identify what are the revenue weightings. What are the aspects or the segments of the business that contributes a greater share of revenue to the entire business? So we notice in the right column we see group, and on the left, in the left columns, we notice retail banking versus corporate and commercial banking versus treasury, etc., etc. And we want to see what aspect of the business is carrying the most revenue. That's how we can identify the risk factors happening to the business. Because, for example, if we notice that retail banking is offering the greatest share of revenue to the group, it means that if something happens to retail banking, it will materially affect the entire net revenue of the business relative to the segment that says investment management services, because it has a much lower contribution in terms of revenue. Now, here is where the script will change a bit. When we look at the profit before tax by segment and how the profit weighting moves throughout the business, we'll see a difference, because the segment that generates the most revenue for the group is not always the segment that generates the most profit for the group. So after looking at the revenue weighting, we have to look at the profit weighting and say, wait, all right, which business is contributing the most to our profit? Now, we want to look and make that type of assessment. What we can also do is to look at the segment margins. What do we mean? We look at the profit before tax for each segment and divide it by the revenue for that segment to identify the profit before tax margin, the PBT margin for each segment. That is another way of looking at what segment is most profitable in terms of margins for the group. So just hypothetically speaking, a segment can have a lot in terms of its revenue contribution, but on the flip side, it might not be contributing that much in terms of profit. Now, we want to look at our balance sheet, moved on from the income statement, and we want to identify what are the segments that we want to look out for. So an easy one, the cash and the cash balances, we want to look at the cash resources within the firm. And it's good when we look at cash on a trend basis. How is cash moving year to year within the firm? Is it trending down? Is it trending upward? Is it volatile? That's very important. Now, what we'll also do is to look at how much cash there is in terms of its assets relative to other types of assets in the business. So for example, we spoke about the current ratio earlier. We'll use the cash resources to form a part of the analysis. So we want to look at it on a trend basis over time. Now we're going to go to the other segment of the balance sheet, not just the assets, we're going to look at the liabilities and the equity. Now, the liabilities are the funding source for the assets, as mentioned previously. The first line item on the liabilities is deposits by the public. Now, what's the significance of deposits? The deposits are actually what customers come in and give to financial institutions in the form of savings. So when we say we have a savings account with XYZ institution, it typically appears in the form of deposits on the balance sheet. Now, the deposits are seen as liabilities because those deposits command what is called interest. When we have savings with these institutions, the institution has to pay us interest for saving with them, and that is why it is treated as a liability. Now, the next line is due to other banks and financial institutions. Now, what that is, it's showing how much financial liabilities in terms of what would have been borrowed from other institutions. Because remember, financial institutions borrow, that's their weapon. It's showing you how much they borrow relative to how much they are collecting in interest. So in the liability section, we will see due to other banks and financial institutions. But if you go back to the asset aspect, back to the previous slide on the assets, we can see due from other banks. Now that is in the third line item on the cash resources. So we want to look at the due from versus the due to and to see whether or not it's going in the right direction. Because they should be receiving more than they're paying in terms of borrowing, because that's how the institution ultimately makes money. Now we're going to skip over this, making progress now, looking at the cash flow statement. We mentioned before that it cuts out the fluff that is in the other income statements, the other financial statements, like income statement and the balance sheet, and it really shows the relationship between the moving parts within the business on a whole. Now, the CFO. At a high level, what I want to mention is that CFO for financial institutions is that sometimes we will look and see that the net cash provided by operating activities might be negative. And we might see that and say, boy, we might say profitability doing so well, but we're seeing that CFO is negative. The thing is that, remember that banks and other financial institutions of a particular nature, they borrow heavily. So because of their borrowings, they will have a CFO that's a little bit different. In terms of their interest expense, they might have a greater portion of their cash flows going to interest expense relative to a manufacturing entity because of how much they borrow. So in simple language, where a manufacturing entity will have physical goods as their inventory to sell to clients to generate income, what financial institutions do is borrow and use that borrowing as their inventory to convert into financial solutions to generate income. So because of that heavier level of borrowing relative to other types of businesses, such as manufacturers, from time to time, we can see CFO being negative. So that is why it is very important to identify the cash flow statement, how it is moving, and contextualize it by the type of business it is in. Now, CFI, as we mentioned previously, CFI is dealing with the purchase and the sale of physical assets like property, plant, and equipment. And what we will look at is how much the firm is spending on PP&E and other fixed assets throughout the year. So we notice that these things will change, and it's very important to look on it on a trend basis, because what the cash flow statement does, as April mentioned, is that it represents a flow. It's showing the movement of cash. So it's very good for us to look at the balance sheet, the income statement, and the cash flow statement together to get a fulsome picture of what's going on in the business. Now, qualitative factors. The firm is typically, financial entities are typically at greater risk if revenues are highly concentrated in a particular segment. Previously, we looked at the segment analysis, and we would have noticed that all segments do not contribute an equal weighting to revenue. So if you notice that there's a firm with 5 segments and 90% of the revenue is channeled through one segment, it means that there's what is called concentration risk. So it means that the revenues are concentrated in a particular business line, so that if that business line comes under stress, it will stress the results of the whole company by a great extent. The next thing we want to identify is whether revenue is highly concentrated to a specific industry. Now, in our financial statements, we can actually look for a breakdown in the notes to see where loans. We don't have it here, Simon. We don't have the industry exposure here, but it's in the notes for some financial companies to show the sector exposure, so we can identify whether or not a firm is lending a lot of money to tourism relative to regular retail activities versus agriculture. So to put that into context, if a firm, for whatever reason, has 3/4 of its portfolio concentrated in tourism in terms of its revenue streams, it means that a scenario like COVID would have a major impact on that firm compared to a firm that doesn't have that level of concentration in tourism in terms of its revenues. So we have to look at revenue exposure in terms of industry, so we can identify how sensitive the business is from an industry perspective, and what percentage of the business's revenues or profits is generated overseas. Now, some firms, some financial entities have decided to move on from local shores in order to identify greater business opportunities. Now, this is a good way of identifying how much stress this company would face from competition, because as we would have identified, the local landscape in terms of financial entities is very competitive. We notice there are players that are coming onto the market in rapid succession, and what that will do is that it will pressure margins. It means that the amount of fee income that a firm might be able to command with only 3 firms in an industry will not be the same level of fee income that it can command in a firm with 10 players. Competition with 3 players is very different from competition with 10 players, because what it will do is that it will start to have a scenario where customers will have greater bargaining power, and we would have seen companies lowering their fees, for example, for trading. Many firms have been lowering their trading fees, and that's an example of competition at play and how it can pressure margins. Now, we want to look at where interest rates are headed in the economy. Because borrowing and other financial liabilities are the lifeblood of most financial entities, these companies have a very high level of sensitivity to interest rates. So, for instance, if we have a situation where interest rates are trending downward, it means that the business strategy will have to change, because the amount of interest that firms can charge to clients will be lower. Why is that? Interest rates are built up in layers. What do I mean? An interest rate has many things layered into it. There are many considerations that a firm uses to price its lending. One, it would be the amount of resources that are out there available in terms of lending. And that would have to do with the interest rate environment. If interest rates are low, it means that money supply is high. That's the first thing. The second thing is, what is the level of risk am I taking with this particular borrower? Now, we would increase the interest rate if the borrower is of a higher risk profile versus of a lower risk profile. And there are some other considerations in terms of pricing that risk. So what we're saying is that interest rates have a significant impact on the economy itself, but an even greater impact on financial sector entities in particular for these reasons. And lastly, we want to look at what are the legal and regulatory issues. Financial services companies, once upon a time, they were very limited in what they were allowed to invest in from a regulatory standpoint. Because of FinSac, what the government of Jamaica decided to do was to determine what financial sector entities could and couldn't have invested in. So once upon a time, there were companies that were in the financial sector that were investing in, for example, cattle farming, um, not just cattle farming alone, but other non-core activities. And this brought our financial sector under immense stress, because they were using customer deposits to put it in businesses that they didn't understand, and firms were really and truly misallocating the funds at the time. Now, as a regulatory measure, the government of Jamaica said, look, we can't allow these companies to invest clients' funds just as they feel. You're going to now be able to invest in A, B, and C. Now, because the entire financial sector is investing in A, B, and C, it would limit the amount of flexibility that these firms would be able to offer in terms of services to their clients, because everybody only has A, B, and C available. Recently, the government of Jamaica has said the economy has changed, the risk position of these companies have changed. Therefore, we're going to add D and E to the amount of investable assets that these firms can invest in. And when we're talking about this, we're talking about alternative assets like real estate, for example. They can take a greater amount of allocation. They can start looking at private equity now. And we're talking about investments linked to pension fund management, for example. We discussed that earlier. So what we're saying is that regulatory issues have a great impact on what firms can and cannot invest in, and that also determines how firms function in the sector. Now, we want to look at a few efficiency considerations. Efficiency is very important to financial entities, because that's what determines whether or not they can pay steady dividends and generate returns on a whole, high quality returns. Now, we want to have an operating expense ratio that is favorable. And it means that if operating expenses are trending upward, meaning that if interest if operating expenses are growing faster than revenue, it means that the quality of earnings will deteriorate. So we want to have an operating expense ratio that is trending downward. We want to look at things in terms of trend. So we're not going to just look at this year versus last year, but how have things been moving over the last 3 years, over the last 5 years. So that will show you how management has been managing the operating expenses of that business relative to its revenue, because that's what's determining management skill, because the management of operating expenses takes skill and it takes prudence. Now what it will do is that it will enable the firm to access how the operating expenses are impacting profitability. We mentioned that previously. And the next efficiency measure we want to examine is the asset turnover ratio, which would be total revenue over total assets. Now, what that does is that it shows us how the assets of the business are bringing in revenue, which is very important. And when we compare this on a firm by firm basis with its peers, we can see whether or not a firm has more bark than bite. If it just has a lot of assets, but not generating that much revenue compared to another firm. Now, some liquidity considerations. The FSC, they have some measures that they use, and they are classified as Tier 1 capital requirements and Tier 2 capital requirements. It sounds very fancy, but the truth of the matter is the regulatory entities, particularly FSC in this case, they determine how these firms are performing in terms of how they are preserving capital in the business. Because what financial entities have to determine is how much risk they can take without tripping over into the red zone. The red zone would be that benchmark that the regulator set for what is acceptable and what is unacceptable. So in generating returns for clients, these entities have to create somewhat of a balancing act, and they have to master that balancing act. How am I going to look at the investment landscape, which is changing on a daily basis? How am I going to look at the competitive landscape? How am I going to look at what regulators are saying I can and can't do? And how am I going to please my client at the same time? So we determine how compliant firms are by looking at their capital to risk weighted assets. And this is determining how much of a cash buffer, or yes, how much of a cash buffer these companies are actually creating to cushion the risk that they're taking to generate these returns for clients. And it's very useful to compare on a pair by pair basis also. The good thing is this is all calculated already. It can be found in the notes. You just Control F and you search in the notes for capital to risk weighted assets and it should appear. So here we have an example of the Tier 1 capital, the Tier 2 capital, and the risk weighted assets for the firm. And we would see how the firm is performing relative to the regulatory requirement or the benchmark. So we're seeing where the benchmark for this firm, in this case, is 10%. And this firm has a capital to risk weighted asset of 17.01%, which means that they're compliant. And we would have noticed that relative to last year, they would have slipped by about 96 basis points, but that could be contextualized by them growing the firm. And this is within the context of BOJ, and we would have seen it within the context of the FSC, and we would have seen how that's different, because the BOJ, they regulate banks, where the FSC regulates non-bank financial services entities like insurance companies, investment banks, and so on. So for a conglomerate, they would have had these two different measures, looking at the company by their respective segments and using the applicable benchmarks. So that's why we would have seen both the BOJ and the FSC benchmarks in this presentation. Now, other considerations, just things to keep at the back of your mind. We expect debt to equity ratios and current ratios for financial institutions to be elevated compared to manufacturing or distribution firms. That is because these companies borrow a lot, and there's a lot of cash flowing through the business, a lot of financial resources and liquidity flowing through the business relative to other types of segments. And that's why we would have seen these metrics being a little bit skewed in that direction because of the amount of borrowing that they do and the fact that these firms use their borrowing as their ammunition to generate returns relative to a manufacturing entity. So financial institutions are highly sensitive to interest rate movements due to their business model. I just mentioned that. We want to pay keen attention to the credit rating as it speaks to the quality of debt of the firm. I'm going to say this very slowly. If the quality of the debt is poor, it means that the quality of the equity is poor. Why is that? That is because in the capital structure, debt ranks senior to equity. Let me break that down. It means that if company X comes under financial stress and they have 100 million in capital left, but they owe more than that 100 million, what that means is they're going to pay off all the holders of debt before they pay off the holders of equity. And the equity holders are the shareholders. So what we want to identify is how companies are managing their debt levels. If a rating is available, to look at the quality of that debt, and then we use that as a proxy to determine the quality of the equity. Because the quality of the equity cannot be greater than the quality of debt, for reasons we just mentioned. Now, we have two types of assets in terms of investments for financial entities. We have on-balance sheet assets, and these are typically owned by the company, such as repurchase agreements. And we have off-balance sheet assets that are not necessarily directly owned by the company, but rather the clients of the firm, such as, for example, the unit trust. So when firms have participating collective investment schemes and they put their money together, they want to look at yes, Mark, I'll address that. Thanks. What you want to look at is how over time the investment landscape is changing, and that might affect whether or not firms look more to off balance sheet versus on balance sheet assets. What do I mean? In the past, we were much more focused on balance sheet assets in Jamaica. Investment firms used to focus mostly on repurchase agreements because of where the economy was at the time and where interest rates were at the time. So it means that firms could take less risk and get a higher return. I know that sounds counterintuitive, but because of where the economy was at the time, they would have focused on those types of assets. But because Jamaica's fiscal position has improved so much, it means that it's more favorable for risk-taking conditions, and firms will focus more on off-balance sheet assets now, such as unit trust and other types. And that is the end of my segment. Are there any questions?
Thanks for that share, Julian. Um, you know, I really liked how you went into some of the details of financial companies that we tend not to look at. You know, sometimes, especially because financial companies locally have been so profitable, everybody tends to go directly to net profits. Oh, net profit is up. Excellent. Bye. Right?
Yeah,
However,
yeah,
they
yeah.
don't necessarily consider, well, some investors don't necessarily consider that the cash flow statement matters, especially with financial companies, the strength of the balance sheet matters. And the strength of the balance sheet, as you mentioned, would be embedded in, you know, not just the amount of leverage, but the type of leverage, meaning the type of debt, whether it's good debt or bad debt, etc.
Right, right.
Very important. So, guys, we're taking questions for the financial companies. I saw one question up top. I'm going to go try to find it back. The Guyanese question is capital to risk-weighted assets only attributable to financials? I think he's talking about financial companies.
As far as I know, yes, because it is a regulatory measure for financial companies. Because what they're doing is looking at how much financial risk are you taking versus your hedging mechanism against those risks. So what it does is that it is showing you the amount of space you're giving yourself to take risk. And that's the
Okay.
whole purpose of the benchmark.
I see David said that pension funds too, but I believe that pension funds are actually a part of financial companies, so
Right.
it still falls under the same remit. Um, Somebody asks, let me just put it up for you. How do you evaluate a company's talent pool? So you just spoke about how important talent pool is.
Well, so here's what we can do. It's not easy to value human capital, and we have an issue with that globally. But the best we can do is to do due diligence on who the managers are, to actually look at the profile of the managers. What are the qualifications they have? What are the amount of years under their belt in the field? So many times we look at reports and we will see certain information about managers and scroll past it, but it actually gives you somewhat of a proxy of whether or not a person is equipped to do the job based on their qualifications and their experience, and to look at whether or not the team is solid in terms of how well the skills complement each other, and whether or not you have a team of persons who are experienced versus one person who is experienced and a lot of other persons who don't have any experience. Repurchase and reverse repurchase agreements. All right. So a repurchase agreement. Essentially, I mean, I don't really want to get too granular, We're trying to find the best way to phrase this. So essentially, a repurchase agreement and a reverse repurchase agreement is essentially two sides of the same transaction. It just depends on where you fall. So the person who is the person who is lending, I believe, I'm not sure. Help me with this time, man. I kind of get confused.
Okay, sorry, I was talking, but I was on mute. So
Yeah, man.
effectively, repurchase agreement. Let's take it on the repurchase agreement side.
Yeah,
Basically, repurchase agreement is you saying, "Hey, I have this amount of assets. I
right.
need cash. I don't want to sell these assets now.
Yeah,
I am going to give you these assets to hold for me,
for the time being.
um, and then you are going to lend me X amount of cash. It's usually a percentage of that amount. And in Y period, let's say in 3 months, 1 month, 2 days, 1 day, I am going to pay you back that cash, and you're going to give me back my assets. And of course, that's usually done with some form of interest. The reverse repurchase, as Julian said, is a flip of the same coin. So if Julian is doing a repurchase agreement with me, I can do a reverse repurchase agreement. So for example, a repurchase agreement is where you have assets and you need cash, right? Now, the thing is that there are a lot of investors out there that have cash and need return. So they have the ability to lend to other institutions, lend quote unquote, through a reverse repo. for interest, and that's how they do that. I think Stephen was alluding to how this might affect interest rates going forward. Now, a couple of years ago, repurchase rates, repo rates in general were relatively decent. Financial companies made their make still make their bread and butter from repurchase agreements. However, the thing is that as the years have passed, the rates on those agreements have gone down. And as such, financial companies are now making less and less money. And as such, this is why you see financial companies moving into other segments, such as capital markets and expanding their footprint into other sides of the business outside of just depending on repos or interest income overall.
So essentially, the reverse repo versus the repurchase agreement is just the buy side versus the sell side of the same transaction. One is a borrower and the other is a lender.
Yes. So is it like purchasing the repo before it matures? Well, um, for companies that enter into repurchase agreements, they can break the repurchase agreement before either side can break the repurchase agreement, but it usually comes at a penalty.
Right, because they typically hold that asset until maturity. Because by nature of the asset class, people normally buy and hold that. They don't typically break the agreement before time. Normally they hold it to
Mhm.
actually earn that interest until it is matured.
And we have one more. I wanted to make a comment before we move on, Julian, because I think this financial company one is especially important.
Sure.
So David made a point that there's a $1 million minimum for repos. I know a good amount of companies actually don't accept below a much higher number. Um, and that's because the average cost of doing it over the years has not necessarily changed, but the average income that companies make from it has
Or
gone down.
low.
Yes. So the thing is that a lot of older investors made a lot of money from repurchase agreements back in the days. They would just put their money into this relatively safe thing, and they'd come back and get X% over a period. Now, as those rates have gone down, a lot of that, and I will call it old money here, just to continue with fun, a lot of that money has moved away from repurchase agreements, even not just from the retail level, but from the institutional level towards the stock market, right? Which is why, and of course, as money comes to the stock market, it needs to find assets, and that has propped up some of the companies as well. Not propped up meaning that fundamentals haven't improved, but definitely the profitability of our equity market has improved.
Yeah, and it has
Um,
definitely driven the index significantly.
Uh, Julian, can you take one more question?
Sure.
Okay. So, can you speak a little to asset tax, Saint Sergio? Can you speak a little to asset tax and its impact on the financials? Would the removal likely increase dividend payments, or would this money just go back to the business? Very good question.
Okay. So the asset tax. The asset tax is a mandatory obligation that financial entities have to pay because of the assets that they have. And because of one of our IMF agreements, we had to actually increase the asset tax that firms pay as a means of trying to improve Jamaica's financial position. Now, because Jamaica's financial position has improved significantly over the years, there is talk about whether or not the asset tax should be reduced. And there's a heavy leaning to it being reduced. Now, what that would do is to allow a greater amount of the company's revenues to go straight to profit because they would be paying less in tax overall if the asset tax was to be reduced. Now, in theory, the company would be able to pay out a greater amount of its profits in dividends because of the savings that it's making on a lower tax rate. However, it's up to the discretion of the board of directors of that firm based on the company's objectives and where the firm is strategically. Because firms typically agree on what is called a dividend payout rate. So they will say, okay, we will agree to a dividend payout rate of 20% of earnings. So even though earnings are growing, it won't necessarily increase its dividend payout rate above 20%. Why is that? Because you are already receiving a greater amount of dividends because you're getting 20% of a bigger number because of higher profits. So a part of managing that dividend decision has to do with the discretion of the board of directors of that company. However, in theory, it does give the company more leeway to pay more dividends, but it's definitely not a must. A case by case scenario.
All right, thanks, Julian. Thanks, Julian. I do want moderator, draw me up. Julian, excellent presentation. Shanti, let's go. All right, it seems like Shanti is having some technical issues as well. Boy, me no want to call the name, but that certain company. But let's keep it going. So next we have Mr. Richard Gordon, CFA, CAIA, who will be talking to us about real estate and private equity companies. Now, Richard Gordon is a vice president of one of the largest financial companies locally. He's a vice president of asset management and research. So guys, trust me. You see the information that you're getting here, premium information, Richard, the guys pay this man thousands of US dollars just to talk, guys.
All
So
right. Thank you very
I'll
much, Simon.
I'll just hand over to Richard.
Yeah, thank you very much for being inaccurate in all of those sayings, but thank you very much, and very good work, Julian and April. So just gonna give a brief. I mean, April and Julian have done such a good job. It's really just about giving a quick overview in terms of the real estate and private equity companies, trying to break it down as simple as possible. So if you have any questions, you can always get that during and after. All right. All right, let's go. Ready? All right, so starting with real estate. So, I mean, everybody kind of has an understanding, very basic understanding of real estate. It's something that we can actually relate to. We either live there by renting or buying. So, real estate investing has come a lot more popular over the last, several years, mainly because of, how real estate market has improved, has increased over the years, in addition to so many real estate companies becoming listed. So, real estate companies are really supposed to be an alternative form of investment. It's supposed to be a hedge against inflation, against devaluation, provide some amount of lack of correlation with other financial assets so that you can benefit via diversification during times of crisis. And in good times, you'll get stable and steady appreciation in value in addition to increased rental income. All right? Ready? Right. So when we're looking at real estate, we have to look at so many different factors. But the first thing is that I believe you have to look at what's the business focus of the company, because you have so many different real estate companies that look at different things. Some person might focus on residential, some persons might focus on commercial, while some persons have a mix. Do persons focus on short-term versus long-term, type of relationship. So it all depends on what you kind of want as an investor, which one kind of matches up to your risk profile. what you know is that, commercial properties are generally longer term leases. So if you're looking more for that type of stable income in commercial, might be a little bit more less volatile and more residential properties. Same thing with long-term versus short-term. So it all depends on what your risk profile is. It's very important also to look at the expertise in the field. What you find is that you have to know when you're investing in a real estate company, what type of expertise, are involved and associated with the company. I know somebody had asked earlier about talent pool or valuing talent pool. This is something that you need to know specifically regarding real estate. You have to have the experience or have the ability to garner people with the experience, because that is a very specific field. So in terms of property yield, so what you need to do when you look at the income statement of real estate companies, you need to kind of look at what is the yield of the properties that you're getting from that company. Naturally, what you want is companies that have a high yield. So the income relative to the property value is very high. So naturally, companies that have a net operating yield of 15% is much better than a company that has a net operating yield of 5% from the real estate perspective. Because that's what you want. You want companies that can generate a high amount of rental income from their properties. In calculating this yield, sometimes you have to make sure you account for any debt incurred, just in case you have to borrow monies to purchase these properties. You have to make sure you account for all of these things. You have to look at occupancy levels. A lot of these things, as Simon and April and Julian have spoken about, are incorporated in the notes. These are very, very critical. But what you want is companies that have real estate, have high occupancy levels. Clearly, 100% is the best, but you want them to generally be upwards of 90%, 95% for the most part, to make sure you're maximizing the property. The length of the lease, we spoke about that earlier. You want to make sure that naturally the longer the length of the lease, you will have more stable income over time. So in terms of getting dividend flows from these companies, it will definitely offer a much better rate of return from that perspective. You have to also assess the balance sheet. No, can I continue, Simon? So, you have to continue assessing the balance sheet. You have to look at the receivables in particular. You have to make sure that, these financials, they're accounting for income on an accrual basis, I believe. So you want to make sure that they're actually getting all of the rental income. It's not being, have it tied up in receivables over donkey years. So there are several companies that are listed on the stock exchange. We have the recently listed First Rock. You have Panjam, who does some amount of real estate. You have the 138 Kingston Properties. I think there's Epley. Probably forgot to throw in Epley right there. That would have been a good one also. So you have several different companies. So these are just some of the key metrics that you want to look at. One thing that I definitely want to incorporate and think about is when you look on the income statement. Let's go to the next slide. Next. Oh, going straight to private equity. All right, go back. So so when you look at the income statement for real estate companies, what you'll notice is that you will show rental income and you will show direct expenses related to those properties to give you almost like a gross profit, so to say. I think April and Julian went through that already. What you kind of want to do is also notice that on a lot of these real estate companies, you're going to have a line item called fair value gains. What you have to actually do, is you have to be able to strip out those fair value gains. Reason being, what you want to look on is how does the cash that you're earning from the business, is it able to cover all of your direct expenses? So what you find is that some companies, they have a sizable amount of fair value gains. So when you look on it, as we spoke about earlier, you look on it and you see the company making more money. Yeah, let's buy it, it's a good company. Right? Not really. Because what you find is that even if, they get generating rental income, but a lot of their contributor to the bottom line is actually fair value gains, which is a non-cash item. So it's something that you have to really strip out those fair value gains in real estate companies to kind of see where the real value is. Naturally, you'll get fair value gains, but you have to take into consideration that some of these fair value gains is not, if you actually try to sell these properties, you won't necessarily be able to sell it at these prices, but you're actually taking it on the books. So you have to kind of go through the financial statements, go through the notes in detail, and kind of do your own assessment. But for sure, what you have to do once you look at a real estate company is to really strip out the fair value gains to say, how profitable would this company be if I were to take out all of these fair value gains in particular? It's very important, and I find that we don't look on that part enough. So we can, I would say that to everybody, if you're looking at these companies, just look on the income statement, strip out the fair value gains, look, and then you compare and say which company is actually doing best, which company has the highest net operating yield. That is what you want to look at when you look at some of these real estate companies. Yes, I don't know if anybody has any particular questions specifically about some of these companies. Not like I follow them all, but
let me check the comments for you, Richard. So you're accepting some questions now.
Yeah, man. Because I mean, Julian and April did such a very good job. They've left little for me to do, so I'll accept questions on real estate right now.
Okay. You guys on the streams have any questions for Richard so far as it pertains to the introductory part of real estate companies? I think everybody was just agreeing with you, Richard, that it's very important for companies, for analysts or for investors more specifically, to strip out fair value gains and really look on how much cash the business is generating. Somebody asked, well, I don't think this is a question. Well, let me just pose it to Richard.
What's your personal view on the talent pool of First Rock? I haven't gone through it specifically, but I mean, it's a startup company, it's a young company. So you have to take that into consideration. I know that on the board, they had some persons who are associated with real estate. So there should be some amount of expertise there. But in terms of details of the management team in particular, I can't really say about the talent pool specifically. Does Jamaica actually have an actual knowledge? Does Jamaica actually have
an acknowledged REIT sector?
So the REITs, so even though we said that we speak about REITs out here, I mean, REITs from my understanding, you kind of have to be like passed in law. There are specific things that you need to do to qualify as an official REIT. And one of them in particular is that I believe you have to pay out 90% of your operating earnings as dividends over a particular time to make sure that you qualify. Something like that, if I remember correctly. So we don't have the legislation. So really and truly, when we talk about REITs out here, what we're really saying is real estate companies. But they don't have a mandate where they have to pay out the 90% of earnings or as dividends to shareholders. How COVID may affect housing price in Kingston, will it drop? Well, Stephen, you went straight for the jugular right there, man. I was waiting how long it was going to take before people start to ask this question. I mean, the truth is, when it comes to housing prices, I love this topic because you have so many differing views. You feel that for the most part, people believe that house prices will remain stable. What I believe is that the COVID-19 will negatively affect the market in some way. The question is by how much. I think the banks have been proactive from the standpoint that they have given a moratorium to many persons, if you have mortgages, etc. So, if you're expecting that people might default on their mortgage, over the next 3 to 6 months, it might not happen because they have a moratorium. Banks might even get more lenient over the 3 to 6 months post that period. So without that inability of people to pay the mortgage, especially those persons who had purchased property for Airbnb purposes, it might be a little bit tricky. I think commercial prices will definitely remain fairly stable. But it's a bit touch and go with the residential prices. The question is, when we speak about net operating income or the net yield, the question is, what is the yield that you as a potential investor would be looking at if you were to buy a property for Airbnb? What kind of rate of return, But some of the prices are, you might be ready to accept a very low rate of return. So it's very up and down. I think that there's going to be a slowdown in the market, in particular in residential, at least over the short term. So you might not see a fall off for sure. I don't think you're going to see a fall off, that's for sure. But you might see a real slowdown in that area. The guy needs, what's a reasonable expected return for each 3 to 5 years in terms of percentage? Well, what the truth is, what reasonable is different. I mean, for me personally, I like 8% is usually what I look for, but other persons might be willing to accept, 6% or 5.5% because their outlook is that, I will get a lot of the return on the back end in terms of fair value gains, I'll buy it for 22 million, and the following year it will go up to 25 million, then 28 million. So I'm willing to accept a lower cash yield, to get the fair value gains on the back end. So it all depends on your perspective and how you kind of view it. I like cash up front, and I'm willing to accept lower fair value gains. So that's just a personal view for me. How do companies measure fair value appreciation on the investment property? Not sure, but let me see if I can take a stab at it. So how do companies measure fair? So what you value the companies at least every year. So every 3 years, you have to do a full valuation. Every year, you have to get a valuation certificate for the auditors to show that, whatever you're carrying it at is an accurate measure or value of the property. So what it is that when you value the property at December 2018 at 10 million, and you do a valuation certificate or a full valuation at the end of 2019 for 13 million, that $3 million now is the fair value gain, which comes onto your income statement. That's what it does there. What are the different valuation methods used to arrive at property values? Who is now? Stubert. So you come and give me a headache another day. So you have the cap rate, the capitalization rate, and then you also have the method of comparables, if I remember correctly. So, sometimes they will look at comparable sales within the particular area. They look at the specific cap rates of 8%, 9%. They'll use the rental income that you're getting over the period. And when you divide it by the cap rate, it'll give you a valuation of the company, of the property. So, so it's different in terms of what you find is that on valuation reports, you see them use two different valuation methodologies. You use method of comparables and the income capitalization approach, as they call it, and then either compare the two or use the lower of the two of them, whichever one. So it depends on, they'll usually try to use both methodologies.
So last one, Richard, for now.
Last one, okay. Would it be prudent for us to push legislation? Prudent is a strong word. I don't, right now I'm thinking about it conceptually, it would be good because that means that it will guarantee people who invest in private, in companies that are specifically there for real estate, that the dividends are being paid over to them. Is it prudent? I don't know if prudent to be the best word. You can, you could do it, but I don't know if prudent is the right word for it. You can still get dividends from these companies, but in terms of mandating it, it's neither here nor there to me right now.
All right, Richard, thanks. Everybody's just thanking you for the information so far.
Yeah, man, no problem. The Guyanese. Yeah, man, that's a good one to look on. The Guyanese. Look at KP REIT, look at First Rock, those ones in particular, and you strip out the fair value gains and you see how well the company's income is actually paying for its expenses. And that's what you really want to kind of look on. All right, Simon, you want me to take this one at the end? After?
All right, cool.
All right, so remember that one. All right, so private equity companies now. So private equities now is a definite, it's a new craze. It's been around for many, many years, private equity, but it's become a lot more popular in recent times. So, so the difference is now some people even just have some conversation, very basic conversations with people. In terms of private equity, they say it a lot, but they don't really understand. The real difference between the two is that, private equity is just really investing in companies whose shares are not listed on a stock exchange. While public equity is our companies that are your shares listed, so you can actively trade in and out of these companies. There's a ready market for the shares and you're selling your stake in these companies. That's one of the key differences between private equity and public equity. I mean, naturally, another key difference is the risk associated. You can go to the next slide, Simon. Yeah. Oh, let me start with this. Yeah. So who private equity for? So really, private equity is usually done by high net worth individuals and institutional investors. Reason being, it's private companies who need a large amount of capital. So naturally, you're going to go to your high net worth individuals and institutional investors first. When you hear that the minimum amount that they want is 10 million or 50 million J, naturally the average investor like myself can't afford that. Simon maybe, but person like me, I can't necessarily, deploy that type of capital in any one company. So it's really for those type of persons. Additionally, it's generally for persons who have an above average risk tolerance. Reason being, public companies are different from private companies because of just information. It's a lot easier to get information from a public company when compared to a private company. Public companies, as Simon has stated earlier, you can get your financials. You know, you can almost put your pot on fire that 45 days after the quarter, you're gonna get your the unaudited quarterlies, and by whatever time after that, the end of the year, you'll get your audited numbers. You have time frames, and not you don't have time frames in private companies, but the information might be a little bit sparse. So you have to be willing to kind of absorb that type of risk and knowing the risk of these companies. But in recent times, what you have found is that you have private companies or private equity companies that have come and listed on the stock exchange. So what it has done is allowed average investors the opportunity to participate in these companies. One prime example is Portland JSX. That's a choice one. I mean, you have several companies that operate like a private equity company. You have companies like Panjam, who does real estate, plus equity, private equity plus public equity. You have companies like Proven, First Rock. They say they do some amount of private equity, and I've read recently that they've taken some stake in a small lending company. So you have many companies nowadays that are listing. So it's allowing small investors to actually be able to capitalize on this market, so to say. And yes, man, Proven for sure. They're definitely one of the pioneers in that regard in terms of listing. Right. So we spoke about the risk already. One thing that I didn't kind of speak about is illiquidity. So with a private company, you know, with a public company, you can just go on JC, look on the bid and ask, know if you can sell it. Somebody's putting up a bid to buy it, somebody's putting up a bid to sell it. So you can kind of have an idea of what your stake in the company is worth, what you can get for it. With a private company, there's no ready market. So you can't necessarily go and sell that stake tomorrow. You're going to have to seek out a strategic buyer, somebody who has a similar interest. And from that standpoint, they would have to kind of agree to a particular price. And again, the pricing mechanism is another specific area that gets more challenging because it's very subjective. How private equity companies are valued. It's not like a public company which has a share price and reflects the sentiments of the market. You have to use so many different variables, so many different valuation methodologies to value these private companies, which are usually stated in the financial statements and in the notes. Again, can't implore everybody enough that the financial statements and the notes are very, very critical. Because also what you want to do is to make sure that companies are not changing the valuation methodology from period to period to make sure that the companies look better. So if you're using a discounted cash flow methodology, you have to make sure that you're using a similar discounted cash flow methodology and the same variables period to period. Right? So what to look for in private equity companies? Well, naturally, I think Simon and Julian have spoke about in April is expertise. I don't think we pay enough attention to the expertise in the field. You want to have companies that have done it before, they have run companies, they can identify good opportunities and they can execute on these opportunities. You have to look at the expert and the management team. And I think especially during what's happening now in terms of COVID-19 and the impact it will have on the financial sector, the manufacturing sector, the distribution sector, all the different sectors, what you need is for strong management to kind of navigate that very difficult period. With private equity companies, Portland JSX is another very good example. Is track record. They had a very good track record leading up to Portland JSX in their previous one. So that was one of the biggest selling points. Everybody should know that they had flow and they sold flow for multiples of how much they bought it for, which was one of the biggest selling points in the previous one. So that is actually a very, very critical thing. So essentially with private equity funds, real private equity funds it's usually track record. So it's difficult for you to sell to anybody if you don't have a very good track record. That's just the reality. You have 7 to 10 years. And after that period, if you can't develop a good enough track record, your next one won't do very well, naturally. With private companies, so for example, if you know your companies does private equity investments, it's good to know the industry of these investments so you can determine what type of outlook is there for these particular sectors. You have to actually look at the value of the underlying segments. What has happened in recent time is that companies have been investing not necessarily only in private companies, but they're taking stakes in public companies. So what you find is that the companies will disclose how much it made as purchase for a public company. So if you can compare that now to the actual traded value, you can know what kind of value is there in the company. So it's actually a very better methodology because you know how to value that company. and fee structure, something that people don't pay enough attention to. There's a very standard fee structure for private equity companies, which is a 220 principle, which is you get 2% of the total assets under management and 20% above a hurdle rate. Some people have 25%, but it generally varies, stays between that band, 20-25% above the hurdle rate. Hurdle rate is usually around 8%, and that way you can get greater alignment between the investors and the general partner, which is the investment company, private equity company. All right. Next one, Sam. Right, and that's an example of companies that have done who do private equity. You have Proven Investments Limited, you have First Rock, just listed, and Panjam, who does both private equity investments, plus they have a stake in one big stake in Sagicor Group. So they do a mixture of both. So that's a good examples of private equity companies, in addition to Port and JSX. Right, so this is just an example of Panjam. So everybody know that they have about a 30% stake in Sagicor Group, but they also have, minority stakes in companies such as Chocker, Walker's Wood, and Busher Browns in particular. And the recent, I think they made an investment in ITEL BPO. So you'll know that these companies, these three companies, are four companies outside of Sagicor. Well, all the companies outside of Sagicor are private companies, but Sagicor is a public company. So the valuation methodology for these companies need to be very, very specific and very consistent. And that's where the challenge is in terms of valuing these small companies. Next. Right. So somebody asked a question earlier. I don't remember who, but this is a good opportunity to kind of look at a private equity company or a company that does stakes in private companies and a public company and real estate. So we can look at one income statement and you can kind of gather a lot of the information which you spoke about earlier. So when you look at Panjam's financial statements now, their income is generated from three core places: investments, property, and other. Other is, I think, commission and stuff like that. Property is your rental income plus your fair value gains. So remember we spoke about that? You'd have to strip out your fair value gains. Right. So what Panjam does, so they manage their capital, so they have an investment portfolio which they generate income from. Remember all the things that Simon spoke about earlier? They are from note 5 to 13. You cannot look on this in isolation of all of those, going through every single note to understand specifically. So the property right there is supposed to be fair value gains and rental income. So that is right there. You'd have to split that out, go through the notes, split that out, and then you'll get a true assessment of what your net operating income is, excluding fair value gains. But what you can see is that they gain a lot from their share of results from associated companies. So if you look at note 17, right? If you look at note 17, they have a share of the profits of Sagicor in addition to all those other small minority stakes in those private entities. So those form a significant part of their earnings. If you look at it, it is more than 50%. More than 50%. Which also includes a gain on disposal of shares. And when through the notes, it's actually they sold some Sagicor shares right there. So that's probably a one-off thing. So you have to strip out that one-off gain to get a true picture of the financial statements. So just walking through this is how you probably should look at a Panjam. You have to really strip out those specific areas to know what's a core performance like outside of a Sagicor. How does a core performance of the company look in terms of it's managing its investments, managing the rental income, and managing the expenses. So it's very critical to look at it from that standpoint. The fair value gains is very critical in removing, just to get a better picture, because fair value gains is very subjective. You can get two different valuators to look at the same property and they come up with two different values. One might value a property at 30 million, one might value it at 28 million. So it all depends on who is the evaluator. So in order to remove some of that subjectivity, we'll always try and remove the fair value gains from the P&L to see the core of the company. So again, we spoke about net operating yield. What you'd have to do actually is to strip out the fair value gains from that property line to get your rental income or your net rental income. And then you divide it by the value of the properties on your balance sheet. So it's critical when you go to these companies, you have to go through the balance sheet also. Right, so if you're looking at the balance sheet now, you're seeing that they have Note where right beside note 60 is investment properties that have over $9 billion in investment properties. Somebody had asked earlier, how do you know or calculate the difference between the two? You know, it's right there. If they valued some properties in 2018, 8.3 billion, assuming that they didn't purchase any new properties, those same properties will be valued just over $9 billion. So again, if you look at the cash flow statement, I don't think we added the cash flow statement here, but again, I think, I didn't. Right. But Simon and April and Julian went through it. The cash flow statement is equally as critical because you want to strip out all of those non-core items, depreciation and fair value gains based on appreciation, etc. They want to really just review the cash flow statement and it will strip out all of those things for you. So looking at real estate, looking at private equity, is a matter of your risk tolerance, what your focus is for real estate, if you prefer to have more residential, more commercial, if you want to have a diversified real estate company versus a non-diversified real estate company, all depends on your risk profile. But, based on what I've said, it's just good to just go through all of these real estate companies, the First Rock, the EPLI, that's another good one to look at, and the KP REIT, and really strip out fair value gains and compare some of those ratios, and you really get to see these companies. All right? I think that is it, Simon. I don't know if anybody had any questions on private equity in particular.
Yeah, man. So we can open up the floor for questions in private equity.
All right. Yeah, everybody good in private equity, man. Real estate around the place, so that's what everybody want to hear about. Real estate, naturally.
Yeah, but also, Richard, what I wanted to do was dedicate around between 5 to 10 minutes. I have invited back the panelists, Julian and April. And so if there are any overall questions as it pertains to financial statements, they can chime in and answer any questions you guys have now. So guys, remember what this is, we are here to share as much information as we can with you. We can create some form of ripple effect in society and we can have an overall broader benefit towards the country. So somebody asked, what opportunities are there? Let me see if I can. So what opportunities are there to get, this is for Richard, what opportunities are there to get into private equity privately? What are some return on return, required returns to expect?
Or what opportunities are there to get into PE privately? Well, one thing is that you need capital. That's for sure. You need capital. And what you need actually is as persons who have the connections to some of these small businesses. You need somebody who can provide that avenue and be that middle person. So the access to capital is very, very critical. The opportunities there, and opportunity will come up now. Given what is happening locally, there will be more opportunities for sure that come up in the private equity space. But in terms of access, that has to be done on a case-by-case basis. What are the rate of return expectations? Well, how I look at it is this. I start by saying, if I were to invest in an NCB or a JMB in particular, what rate of return would I expect? And when I gather in my head what's the rate of return that I require for public equity, I need to add that premium, because that premium now is supposed to reflect the liquidity of the stock, the fact that it's difficult to trade, I might have to take 5 years to get back my money, etc. So usually, I don't think people should be going into private equity expecting anything less than minimum is where 15%, out of 15 to 20%, what you should really be expecting based on the additional risk, the liquidity of the stock, etc.
And from my perspective, from the capital market side, what I'd say is that the transactions that are generally seen in this space, as Richard said, has an added premium to the public equities. So as Richard say, if you think that you could make X% on the local market, owning a public company, the thing to do is add a return on top of that and charge and that's what you would want from the private company. So I see returns probably from as low as 10 Richard, up to 40-50%. So
Yeah.
it really depends on the type of company as well.
Correct.
So Mark asks, well, it's on this.
Why do the local market consistently undervalue PE relative to other financials? Well, in my opinion, I think that people haven't fully, the average person, the general market hasn't really fully, they don't fully understand private equity, and they can't necessarily value private equity. So you can't value what you don't know. So I find that with those companies, you can have a whole lot of unrealized gains on the balance sheet from companies that you bought into a company at $10. It's known public, and the share price of that company is gone up to $50, but it's not being reflected in the price. You know what I mean? Because I don't think we're tying the dots as much as we probably could. There's a whole lot of value on the balance sheet, but I think we're gradually moving towards it, but we're still kind of focusing on, as I think they alluded to it earlier, just income statement. The company make more money, then fine. But I don't think we're really looking at how much value is there on the balance sheet. So I think it comes down to information and knowledge in terms of understanding how to value the private companies. I think some private companies that are listed probably need to do better in terms of providing information to the public. You know what I mean? That will also help. The more information you provide, the better able they are to do a better valuation of the company. So I think it's two-sided, but I think that generally there needs to be more information given and more information put in.
Yeah, man, that information point is very important, because I think, a matter of fact, even some public companies don't provide enough information for us to do our analysis. But Soti made a very good point here, Richard, about sweat equity, which can also be done. You know, if you believe that you have a skill or a talent that may benefit a private business, then you can approach them and say, hey, I can do this for you. This is what I can do. And I can do this for X percentage of the business, you know.
Yeah, and it happens several times. People have a very good idea, competitive advantage, first mover advantage, all of that. But you need the capital. So you say, guys, I don't have the money. But here, if you give me 2% or 5%, I will do everything. I'll take a lower salary over the first 2 years. I just want to make sure I have skin in the game, and I will do everything as if I put in money. So it all depends on whether you have that level of competitive advantage to really sell it to an investor who's going to invest in you, or you putting up capital for yourself.
Yeah. So Roderick says, regarding Signos's APO, do you think that there are businesses available that can get on the cheap and hold until after COVID has passed? I guess they're talking for Signos's APO. Roderick is talking Signos's APO. If Signos can buy companies cheap and hold it.
Regarding Signos APO, well, as I said, the COVID-19 impact is going to be far-reaching, way different from what has happened in the global financial crisis in 2009, in my estimation. So there are going to be a lot of opportunities available. So the truth is that during this period, it's a very cliche, but cash is king. The person who has the cash can look on all and various opportunities versus the person who doesn't have any cash, seeing opportunities, has to sell assets, has to sell it at probably depressed prices to kind of build up his liquidity. So if you have the cash at this period, even if you're sitting on it for a year, you're in a much better position to capitalize on investment opportunities. So, right now, if you have that opportunistic and optimistic mindset, then definitely there will be opportunities over the next, 6 to 18 months, I believe.
Stuart asks, how do you identify and execute PE opportunities? Well, I think the identification part is probably the hardest one.
Yeah, you said it right. It's how do you know? It takes so much research and having the foresight to see what will happen in the future and where the growth is from different industries. So it's just a matter of having that right mindset, keeping the ears on the various information, but you just have to really keep your eyes open. In terms of execution, as Simon said, that's the easiest part. Once you have a good idea and a good business model, you have somebody who is willing to sell or, do the proper transaction, to kind of get, the money. People are out there willing to support these type of transactions. So it's just a matter of identifying it the good, strong industries with good growth potential. So the question is now, given what has happened with COVID-19, you know, what are the opportunities that you're seeing out there? What are the opportunities that you're seeing? So you can see what the COVID-19 will change in how we operate as a people, locally, globally, then you'll be able to see the different opportunities like that. You will see which companies will be doing much better in 18 months and which companies won't be doing well in the next 18 months. So it's just a matter of kind of tying in the dots as best as possible.
And this one is for April or Julian. And of course, Richard, can always chime in. Explain the importance of the correlation between the free cash flow is to firm to the return on equity.
Sorry, can you repeat the question, Simon? Oh, sorry.
What's the importance of the correlation between free cash flow to firm and return on equity?
The correlation.
I guess this is probably free cash flow to equity.
Yeah.
Yeah.
So when it comes to free cash flow to equity, at the basic level, it just means after the company generates the cash from its actual operations and then reinvests it into the business, plus whatever debt repayments it has, whether it's servicing its debt or getting any additional cash flows, what is the actual cash that is left back in the business to pay its equity holders? And that is what free cash flow to equity is saying. It's literally saying after the company satisfies all its obligations, after the company adds back or takes out any non-cash expenses, after the company maybe spends on whatever capital expenditure, and any net borrowings, what is the cash left back? So the actual formula is net income plus, sorry to get technical, but net income plus depreciation plus any change in working capital, and working capital is current assets minus current liabilities plus any capital expenditure plus any net borrowings. And so when you have all of those factors taken into consideration, whatever cash is left back is the cash that is available to you as an equity investor. And what is important to bear in mind is that, again, for you to get free cash flow to equity, you have to calculate first the free cash flow available to, you can say, creditors, because again, remember, these are the persons who are paid before equity holders. So the free cash flow takes that into the consideration as well, with the inclusion of net borrowings. I hope that was helpful.
Yeah, man. He said much appreciation. Hold on, let me do this first. How much weight should I put on quarterly statements?
All right, so I'll tackle this. You should put a lot of weight on quarterly statements. What do I mean by a lot of weight? So quarterly statements, they essentially give investors an update until the audited financials come out, because audited financials typically come out once per year. But when the quarterly reports come out, what they do is to give investors an interim update on what's going on in the business. Now, quarterly figures aren't usually audited, but what they can do is to show you the roadmap of how the company moves from 1 year's performance to another. And it's always important when assessing companies' performance to work with the most recent data that is available. So let's say, for instance, a company's financial year is ending in December. We wouldn't want to wait until December to assess whether or not the company is performing. Because if there's information as at June, then we can use the information in June if we're closer to June than December. So what we're saying is that whatever period you're in, you want to work with the information that's most accurate and most up to date, because time is a big factor. You don't want to wait 4 quarters to see where you're at as an investor. That's a huge risk.
Okay, thanks, Julian. So basically, you're saying the key for assessment a lot of times is the timeliness of your analysis, and quarterly statements clearly um, give you more updated information faster. There's a very good question here. Saint Sergio's basically saying for any panelists outside of cash holdings, what should we look for on the balance sheet to give an indication that a company can weather a potential recession?
Well, people must shoot some serious.
I think for this question, maybe we can answer for each sector because there will be different things depending on the type of company we're looking at. Yeah. What do
Yeah.
you
Go on, April.
Oh no, I was just checking if I could go ahead with that format.
Yeah, man. Yeah.
Okay, so for manufacturing companies, I can start and just from the simplest format is when I was presenting, and I would have stressed the importance of looking at their cash flow statement as well as looking at their accounts receivables, because it's very important to know that the revenue that is being reported for a manufacturing company is revenue that is not solely compromised of non-cash sales. And then the importance is also looking at not only the amount of accounts receivables that they have, because sometimes depending on whatever reporting period, maybe whatever cycle that they are reporting under, maybe at the end of that time they just had a high receivables. But then if you are noticing over a period of time that their accounts receivables collection is down, and especially at this point in time, again, if they are not ensuring that their accounts receivables turnover is improving, as in is increasing over this period, if you've been seeing a company where it's actually been deteriorating or has a high outstanding accounts receivables balance over a longer period of time, or if you're seeing that the company has persistently negative cash flow from operations, especially for a manufacturing company, then those are key things that you need to look out for when you're assessing a manufacturing company's ability to withstand this. Because during this time, I mean, quite simply, you're going to experience sales being down. If the company is solely reliant on whether it's export oriented or not, everything is being disrupted, from trade to even persons now going out and spending any income that they have. Because what you're going to notice now is that during this period, what we call discretionary spending, which is spending at, you can say, at the liberty of the consumer, where they don't have to spend on this product, is going to go down. Then during this time, sales are going to slow, and you need to make sure that that manufacturing company has an adequate buffer in order to still pay their suppliers, still maintain the business, and if necessary, is able to invest back into the business to ensure that they are more resilient at this time. And then at time, one last point is just also, if there's any manufacturing company that has a high amount of debt, and now is the time you need to look at maybe their interest expense over the period. If they have a high interest expense on their income statement, then that again is going to affect the company's resilience over this time, because if they have too much debt and then they're worrying about paying back their debt holders during this time, then that is also a potential sign. That's it for me.
Richard, you're saying something? Okay, so question for Julian. What makes, and I think this comes on the back of the last question. So April alluded to different types of companies and how they would weather a storm. For Julian, what makes a financial institution's balance sheet strong or good?
Okay, so there are some things that we want to identify. The first thing we want to look at is the cash levels. We want to see how cash is trending over time, whether or not the company has been able to build this cash. We also want to identify the capital to risk assets ratio to see what is the quality of the assets that are being held on the balance sheet? Because we can see where the asset base might be growing, but it could be that the quality of the assets are deteriorating because the buffers to risk are not in place according to the regulator standards. So those are two things off the top of my head that we need to bear in mind. Also want to look at debt levels, even though yes, debt to equity will be higher for financial entities relative to manufacturing companies, for instance. We still want to ensure that companies are not going overboard with their leverage levels. But the capital to risk asset ratio will it will be somewhat of a rough proxy for that because it's speaking to liquidity on a whole.
So,
As a
Julian,
long-term investment,
That is non-performing loans. You can look on
yeah,
the level of non-performing loans and
definitely
institution
non-performing loans. Yes, the NPL ratio. So
NPL.
we want to look at the percentage of the ratio. We want to look at the percentage of the portfolio that is made up of non-performing loans, because non-performing loans will essentially create a drag, or it will cause the quality of the portfolio to deteriorate if it's not managed properly. So we want to minimize our NPLs, or non-performing loans.
Julian, there was a follow-on question. As a long-term investor, is it really important to look at quarterly review if you're going 5, 10 years out?
Yes, because years are built up of quarters. So another way of saying 5 years is saying 20 quarters. So that's like asking, okay, if I'm going to invest for 20 quarters, what's the point of why would I not take the opportunity to get that quarterly checkup? Because the point is we want to create a bridge between each financial year. And the bridge between financial year one and financial year two are the quarterly statements that occur in between those periods. So it's very important to actually take it on that level. Some companies are definitely going to be more sensitive to quarterly movements. For example, private equity firms and investments typically require a longer time horizon. So, like an MPC, quarterly financials for an investment like MPC might not be so sexy. Why is that? It's a long term investment, and it means that these investments take a longer time to realize their mission just because of the nature of the asset class relative to a bank or an insurance company or a manufacturer. So we have to take those things into consideration. But it doesn't hurt to take a quarterly look. You never know what you might see.
Okay, Julian, for you again, how do you see financial institutions adapting to the GOG's objective of lowering debt?
Well, intuitively, one would expect the risk appetite of firms to become more aggressive. That's because we would be subject to less systematic risk. What does systematic risk mean? It means that if the economy becomes stronger, it creates an environment that allows institutions to take more risk. So, because our debt profile would be improving, meaning that our debt to GDP ratio would improve and trend downward, it means that financial institutions can change their weightings, meaning that they can focus less on a particular area and look at new areas of how to make money and to be more aggressive in particular segments such as real estate and private equity, more investments in the real economy, so to speak, as opposed to parking it in cash, for argument's sake. Because that was the case about 20 years ago, 25 years ago, when the economy was in a much weaker position. These firms were not really equipped to take a certain kind of risk posture because of where the economy was. So we expect a shift in risk appetite as the economy improves over time.
All right, guys.
Just
So
to
we have
add on,
time for two more questions.
hi.
Sorry, you really had a comment?
Well, I was just going to add on that Julian actually made a very important point about that. And also, a lot of the time, a lot of these financial institutions, especially when it comes to repurchase agreements, use these GOJ assets to back whatever borrowing that they're doing. So when the GOJ is actually issuing less debt, it becomes it creates a scarcity problem, as you can see, in terms of repo eligible assets. And what that can lead to is actually more sophistication in the financial market, because then you're going to see more financial institutions getting credit ratings, because these are also what is stipulated by the FSC, among other things, that would actually make an institution's debt that they issue become repo eligible, because before there was a heavy reliance and exposure to GOJ assets. But because of the relative scarcity now, you're actually seeing more and more companies getting credit ratings, which is a good thing. That means that more and more you're going to see much more assessment and a much more sophisticated financial market, similar to what you see abroad.
Okay, so we have two last questions, guys. We have one from Tanisha Mitchell and the last one from Stephen Dawkins. So one from Tanisha Mitchell, I've actually seen this question pop up a few times. What other resources outside of financial do you guys recommend in adding to investors' toolkits in identifying opportunities? She realized sometimes by the time something hits the media, it's all new. So she basically wants to know things and analyze a company's financials before before the market moves. So what do you guys use? I mean, ladies before gentlemen.
Oh, sorry.
All right, April now hear me. Richard,
Oh, sorry. I don't know why I thought Richard was going to start, but then I realized he said ladies before gentlemen. What other resources outside of financials does the team recommend in adding to our toolkit in identifying opportunities? Well, the financials, really and truly, they can just be numbers, which is why we touched on the financial ratios as well as some qualitative aspects to think about when you're doing your assessment, because you have to understand not only the company that you're investing in, but also the industry that it's operating in. Because if it's operating in, for example, a very highly competitive industry, and if this is a company that is even just starting out, it's a little more difficult for them to get off the ground running and be a big competitor amongst other persons, because they're operating in a very competitive environment. And then at the same time, also, you can just read the newspaper. Little things, little announcements, those are things that can really help you to pick up on what is happening with the company and understanding its operations even more. And then outside of the financials, especially when companies issue their annual reports, it's very good to read. And I know as Jamaicans, we may be a little averse to reading, but the management outlook sometime, or the management discussion, is very good in terms of describing what the company has been doing over the last year. And it can actually even let you do your own assessment of, boy, is that really the strategy to take? Now, if, for example, you see a company say that they're seeking to expand into Mexico, but then you read just a while ago say Mexico have a volcano, then is this strategy really going to work out? Have a volcanic eruption? Sorry, I don't know about any volcanoes in Mexico, but I'm just saying that you can then assess, is this the best possible strategy for the company going forward? So those are the things to consider, those qualitative assessments, aside from the quantitative assessment you're doing using the financial ratios and looking at the financial statements, but also keeping abreast of key events, reading the newspaper, reading Jamaica Stock Exchange announcements, as well as coming to your own deductions as well when you're looking at these and thinking, boy, does this really make sense going forward? Those are the things that you have to think about, and what are key tools I can say when it comes to doing your assessment.
Richard, Julian.
Briefly, just to support April, in addition to the financial statements and looking at the MD&A, we can look at the business papers The business papers are typically on Wednesday and Friday. Now, both the Gleaner and the Observer have articles that allow the management of firms to actually say what it is that they're going to do next. So it's a good source of information of identifying what companies want to do in real time and what their plans are. Then we can gauge those things against the numbers. So the business papers are a good way of looking at it. Um, these papers again are on Wednesdays and Fridays.
And Richard, in answering that question, you also have the last question written on it.
Well, I think they kind of captured everything. Only thing I would say in that regard is that you just have to read widely. So even though we know that the business news is Wednesday, Friday, and Sunday, it has to be so. You have to be reading internationally. You have to read non-economic stuff, non-financial stuff to kind of be able to tie in everything together. That's the only way you can kind of be ahead of information. So if we're reading what was happening in China, we could have said to ourselves, what are the implications? Suppose this were to happen and to spread globally, locally, what would be the implications? We could think and know that from early. Then we're in a very good position. So the only thing I'd say is that I think people should take the level of due diligence that they, with investing that they do with their personal investment. So if you want to buy the newest iPhone, as I tell everybody, the newest iPhone or the newest car, the amount of due diligence that you kind of put into it, I would say if you put that same level of due diligence, read widely, 5, 6, 7 different sources, I think you should be fine. But there's no one particular source that can say you go to this place and you get all the information that you need.
Excellent, Richard. I mean, more people have more questions, but guys, you can drop them on the Stocks on the Rocks, and I'm sure the guys will find the questions on Twitter. But for Richard, the last question: what are the true benefits? So Stephen was a bit skeptical about your PE presentation.
All right.
So he's wondering what are the true benefits of real estate and PE. A lot of bigger money investors get into it. Is there something there that the small man not seeing? Or is it that big money move differently?
All right. So I think I spoke about earlier. So unfortunately, is that before some of these private equity companies were listed on the stock exchange and made more available now to the average investor, it really was primarily for institutional people. It's really big money. So minimum they'll say is that we're not taking people less than 10 million or 50 million G, that type of person. So it really wasn't for the average person like myself. You know what I mean? But over time that has changed. Generally, private equity generally gives you a lot of, there's a significant ability to get good returns. When companies are being listed, that is when what I didn't speak about in the presentation is, walking through the process in terms of when you invest in a private equity, you have 3 to 5 years, how do you exit from these companies? And one way in which they exit is via the IPO. So when you see the company coming and listing at selling shares at $2 or $3, the private equity investor who is exiting at a multiple of 5, 10 times his money because he was been there from before. He's working with the management team, monthly meetings, hand in hand, building relationships with them, ensuring that they get more market share, etc. So he's taken on all of that illiquidity risk to get his return on the back end. He probably even say, I don't even want dividends. Reinvest those cash flows that he would have paid me into the company because I know that if I list this company on the main market, I'll be able to make 10 times that money. The difference is that you probably just don't know how much he paid for his initial investment was. But the reason is that you want to be in there early. So that's the benefit of private equity. So when you go into it from the public equity side, which is the IPO side, you have to be looking further out and say, all right, this company has been around for 5, 10 years. How is this company going to perform over the next 5 years? So you have basically come at a different point in the cycle. But coming in earlier, you will take a lot more risk, and naturally, you will get a lot more return on the back end. So that's in relation to PE. Specifically, I hope I answer your question, Stephen, regarding real estate. What's the real value? Real value of real estate is a real asset. It's different. It's supposed to have low correlation with other financial assets. So if you look at how the stock market has performed over the first quarter, 30%. Our country, the dynamics are a little bit different. You're probably not going to see, you're most likely not going to see a 30% reduction in the value of your home unless it's a significant decline in economic activity across the country. You're really not going to see a significant decline in property value. So what it provides is stability, It provides a diversification and the low correlation with financial assets. It provides stable income, which is a hedge against inflation and devaluation. So as a part of a portfolio, when you have a long-term investment horizon, definitely. Because if you look back, look at if you had purchased some properties over the last 5 or 10 years, you'd have gotten a lot more stable returns. You wouldn't have gotten the returns that you've gotten on the stock market. But again, you also want to make sure that you have various type of assets that cater for different financial needs. So it's really from a diversification and low correlation standpoint. Hope I answered the question, Steve.
Yeah, man, you did. And just stuck on that, guys. From my perspective, from the capital markets perspective, one example may be that a company is a private investor may be going into a private investment and say, hey, I am only going to buy this company for 6 times PE, right? However, when that company lists on the stock exchange, you're listing at 18, 20, 24 times PE, right? So you can just do the maths and just realize that for some investments, there's a material amount of return. However, that is usually associated with the amount of risk that the private investor took on. Any final comments from you guys? I realize that Shanti chipped in now and she's about to pull us off.
Says that it has been a very interactive. I never expected it to be so interactive, but I mean, I really enjoyed just the questions and the comments and following it. I mean, I followed kind of all of them once I wasn't, presenting, and I think they're very good questions. And I think that, if we continue to have more of these things, it will definitely improve. And I'm kind of learning some stuff based on the questions, just hearing how people think. So I think it's just a very good opportunity to kind of have this discussion with everybody.
Okay, Shanti.
Thank you, Simon. So it is that time when we're wrapping up. A big thank you to all our panelists this afternoon. So that's Simon Johnson, Richard Gordon, Julian Morris, April Walters. Thank you so much. Big up to the comment section. You guys were live. You guys were paying attention. You're asking questions. Please continue to do so. Also, please subscribe to our YouTube channel. That's Stocks on the Rock. SOTR. Don't forget to follow us on Twitter. Don't forget the hashtag SOTR. Please feel free to pose your questions. You can also at Guru in Training. Thank you again, and until next time, see you. Stay safe and Tanaya Yard. Bye, everyone.
Okay, guys, hold on, guys. Don't leave yet. We have a post survey that I'm going to be putting in the comments right about now. Please remember to just fill this out for us so that we can get some feedback so that the next time things are a lot better. Remember to fill out that, guys. So I just posted it on the Twitter. I posted it on YouTube, and I'm going to tweet it again for those who missed it. Thanks everyone. Thanks everybody for coming, and see you next time. All right, guys. Take care.
Take care. Thanks.
Blessings.
Respect everybody.